So what exactly is bootstrapping? Bootstrapping is about starting and running your business through your own means, without the help of outside investors. It's not about running a business with no money. There's always a need for some money, but there are ways to reduce big time the money you need to start your business. Not by not spending where you should be spending, but rather by using proven techniques to evaluate what you actually need to spend your money on. That means learning new ways of working to make sure your money is well spent. As you'll see in this course, being cost-conscious is only but part of the solution. There are business development techniques that can have a real positive influence on the finances of your business. They will have you doing what you originally planned, but in different ways, and at the same time cut significantly the investments you need. Bootstrapping is not only about avoiding spending money, it's also about taking actions that cancel the need for some spending. There are many kinds of bootstrappers, from the hardcore one to the one that will use bootstrapping techniques to optimize his business and run his company more efficiently. You'll have to define by yourself what kind of bootstrapper you want to be or need to be. Since a bootstrapper does not plan on using money from outside investors, it will largely depend on the money you have versus the money your company needs. Being a bootstrapper is not about doing it on your own with no outside help to prove the world something. It's about using techniques that make possible a venture that would not have been possible otherwise. By the way, most bootstrappers use those techniques to start their company and get to the size they need to attract investors. So the two are not incompatible. It's just different phases of the development of a company. And using bootstrapping techniques during the entire life of the company is a good business practice anyway. There are 5 concrete things that an entrepreneur should focus on when bootstrapping a business. 4 of those pillars are focused on reducing as much as possible the financial burden of starting a company and operating it during its infancy. The last one is about the impact that bootstrapping can have on the life of an entrepreneur, but more importantly, on how to manage it. The first pillar we'll be looking at is managing spending. We will be looking at the most significant costs of starting a business and how to keep them under control. It's about how you influence the negative side of your financial equation, the money going out. The second pillar is about customer acquisition and customer retention, which is ultimately about making money, generating revenue, and influencing the positive side of the equation. The third pillar is about business management and what mechanism you have in place to determine if you are on the right track or not, and if not, what needs to be done to get back on track. This one is part of our 5 pillars because spending too much time making decisions or potentially going in the wrong direction is a massive waste of money and is usually one of the biggest, if not the biggest, startup killer. The fourth pillar is about competency acquisition. A big part of starting a company is about having the right competencies available. Since competencies means people, it usually also means big money to hire people, money that many startups don't have. So we look into ways that enable entrepreneurs to acquire the competencies they need through different forms of compensation models, which ultimately reduce significantly, if not completely, the bill. And the last pillar is about work-life balance. In the early life of a company, and more so of a bootstrap company, the line separating work and personal life will be blurred at best. Because you'll be working a lot, sometimes from home, you might not be able anymore to make the difference, and that could weigh on your venture. We'll look at some things you can do to make sure that some boundaries remain. So the 5 pillars of bootstrapping include managing spending, acquiring and retaining customers, managing business, acquiring competencies, and balancing work and life. We'll take a look at each of these pillars in the rest of this course. So let's tackle our first pillar, managing spending. I guess this is the most obvious one if you want to reduce your dependency on money coming from financial institutions or investors. The best way is by far not to spend money. If you don't spend it, you don't need it. Some expenditures are more significant than others when you start a company, and the objective here is to take those significant expenditures and look for ways to reduce them big time. Typically, the most significant expenditures are your own salary, the salaries of your employees, office rent, services from professionals such as CPAs or lawyers, and then you'll have a large number of less significant expenditures which bunched together will represent a large amount. Not every company can start on less than $1,000, so the best way to reduce your dependency on money is to plan for alternative ways to achieve your goals and make sure you still get what you need to make your business succeed. So we'll be taking those significant expenditures and review what options we have to make them as small as possible and reduce significantly their burden on the finances of your company. In this chapter, we will review in particular how to deal with all those expenditures except for the salaries of employees. For that one, we'll dedicate an entire chapter. In this chapter, we'll be talking about the positive side of the equation and how to make money as fast as possible to reduce your need for investment. This all comes down to your customers, how fast you get the first one, and how you then line them up until your company has reached its next milestone. We usually have a tendency to think about many things before we get to thinking about acquiring our first customer. We sometimes want to have everything ready before we set foot into his or her office. We want to look professional and have a product to show. And sometimes we see things as if we had to prepare our company to reach a certain level before we speak to the outside world. The problem with this approach is that it assumes we are going to work for weeks, if not months, before we even get to try to get in contact with our first potential customer. And the more we wait to start looking for customers, the more we postpone the time we will sign the first contract and start generating any revenue. It's only then that we will know if all our assumptions were correct about our customers and how our product solves their problems. You need to think about your first customer way in advance of your product being ready. As soon as you know what your product should look like, you need to start looking for your first customer. First of all, most sales are made on a promise more than on a demonstration. Whether you're selling a product or a service, you might have to show marketing material or actual product to your potential customer, but at the moment of the signature of the contract, you don't have to be ready to operate on a large scale. If you are selling a product, you can start getting appointments with companies before you even have something ready. You can meet with them with a single copy of your product. If you are selling a product to consumers, you can put a page online on a website like Amazon in no time and just with a few pictures and good copywriting. It's when the first sale is made that you need to react fast and get your product ready and delivered. If you're developing a complex offering, like for businesses, you could find a customer who is interested in participating in your development in exchange for having a tailor-made product with a very low price. So instead of developing your product on a set of assumptions without speaking to any customer and without making any money, you could find a company interested in the product and propose to develop it for them, fitting all their needs, even the very specific ones, and to do it for a very low, unbeatable price. Some companies are not interested in that because they're under pressure to have something that works right away. But other companies are okay to be early adopters for the potential of seeing their problem solved on a condition that they barely pay for it. But from your standpoint, it means that you can develop your offering with real-life customer feedback that will surely meet the needs of other similar customers. And on top of that, instead of making no revenue, you'll be making some revenue, even if it's a fraction of what you'll be doing with your next customer. It's a way more positive outcome than working in a bubble until your product is ready. Another way still to find your first customer is to see if your current employer could be your first customer. What could be more favorable for a first sale than making it with a company that knows you and with which you already have credibility? All you need to do once you have officially announced that you're starting your business is to speak with the decision maker. If you are starting on your own to propose consulting services for the same skills you're using in your current job, why not propose to your employer to take you as a contractor instead of hiring someone to replace you? It might not feel different from working there, but in fact, it will be very different. First, from a mindset standpoint, for both you and your employer, but also because you'll have the liberty to talk about your business freely and be active online without having to wonder if it's going to be an issue with your current company. In any case, my point here is that you cannot afford to wait for everything to be ready before you start talking to customers or before you start making sales. To successfully bootstrap, you need to start making sales as soon as possible, even if it means sacrificing on price or paying extra money to get small batches of your product. You'll not only be gaining feedback from your customers, but they will also pay you for your product, which will have you started with at least some revenue. And as a collateral benefit, you'll see how good it feels to make that first sale and move from concept to business. One of the most significant costs of starting a business, which we have not discussed so far, is actually not a cost in itself, but a work process that generates significant extra costs for the company. This work process is the fact that we tend to wait too long before being able to know if we're going in the right or wrong direction. By waiting too long, we spend money on the operations of the company, paying more rent, more salaries, and more of everything before we even know if what we're doing makes sense or not. If it does, then that's fine. No money has been wasted. But if it doesn't, we're just throwing away our investment money. As we discussed earlier, we know from the beginning that we're going to make mistakes. So instead of working inside a bubble for a very long time before we speak with customers and get their feedback, we need to do the exact opposite and get their feedback as early as possible. There is no logic in working blindly for the longest time possible. Sometimes we can be afraid to burst our bubble and realize that our project is not viable. Sometimes we can even unconsciously postpone the time of testing if our product will be successful when it will hit the market because we feared of the social consequences of being wrong. Many of us have a tendency to procrastinate when it comes to speaking with customers. What you need to do is actually exactly the opposite and meet those customers as early in the life of your project as possible. To do so, you actually need to think about your product or service or solution and how you can get a version of it in front of customers as quickly as possible. You need to do that, get their feedback, and start working on the 2.0 version of your product right away. That's the version that has been tested by real customers who paid for it and have expectations. That version will have much greater chances to be a success than the first one. Those customers need to pay for the product. If they don't, they'll have low expectations, as many of us have with free products, and so you won't get real feedback and could be tricked into believing your product is good to go. Once you have done that once, you need to do that again and do it continuously. During the first rounds, of course, you'll get the biggest problems with your product out of the way. But as your customers get used to your product and as competition will propose new things, the expectations of your customers will evolve, and so will their feedback. But by working in short cycles, you'll be strongly connected to their feedback and will be able to adapt quickly. Let's take a concrete example. Let's imagine you decide to produce and sell t-shirts, and you want to have those t-shirts with fun pictures or phrases on them. If you want to go into the t-shirt business, you probably will want to buy those t-shirts in different colors. Let's say 5 of them, for example. And the most common sizes. So that will be another 4 sizes for small, medium, large, and extra large. And you might want to have a few pictures and phrases to start with, maybe 10 of them. If you count that, you're already planning on producing 5 colors times 4 sizes times 10 different types of phrases or pictures, which is equal to 200 t-shirts in total. And that's only on planning to have 1 t-shirt of each, which is unrealistic. So if you want to have even just 5 of each, you're already looking at 1,000 t-shirts. Then you need to find a way to reorder and produce fast new t-shirts if one of them in particular is more successful than the others. So the short cycle way of doing this would be to test your plan on a single color with the most common size, which should be either medium or large, with a single phrase or picture. So that's 1 t-shirt. Then you produce a certain quantity of it, even 50, and you're good to go to test your idea. Sure, some people will not like your product, others will like it but would prefer it in a different color or size, or with a different phrase or picture. But some people will like it just as it is, and if you chose the right size, statistically, you should sell some of them. Then, all you get to do is to make sure you have a way to gather feedback from your customers to know what you should do next. The cost of this operation can be divided by 10 or 20, and you test your project all the same. If you want to read more about using such techniques, there's a great book for you to read called The Lean Startup. This book, written by Eric Ries, is more focused on applying this concept to software development, but it's applicable to any startup, in fact. In his book, Eric Ries illustrates this technique with his own experience of not applying it and staying in the dark for way too long, before changing the way he worked and improved the performance of his company. When you're starting your business, you need many different competencies. Some of them can be completely outsourced, such as accounting that you can give to a CPA, and some of them need to be kept in-house. But in the early life of a company, it is quite difficult to have the money to pay for all the competencies you need. You need to find ways to get those competencies without having to hire them all. And if you do need to hire people, then you need to find ways to compensate them in a way that can keep them motivated and at the same time be realistic from a financial standpoint for the company you're running. In this chapter, we will be discussing ways to compensate employees in ways that are affordable for startups. In particular, we will look at ways to tie the compensation of your employees to the success of your company. If it makes more sense for you to work from home during the first few months of your venture, then you need to take some actions right from the beginning to make sure your personal life and work don't get mingled together. At first, you're just working on your computer, writing on paper, and it's not such a big a deal. But if you're serious about your business, then you'll be working long hours from home and might consider in the evening leaving everything open on the table so as to start faster the next morning. In no time, you won't know the difference between your home and office and will have a hard time taking time off and relax. To be able to relax is very important because as you will work on your company, you'll definitely need to see people and change your mind regularly to stay as fresh and sharp. The risk if you never relax is that you get so focused on your work that you start becoming less and less productive with time because you lose the energy you once had. So right from the beginning, you need to be organized to get some downtime between your long hours of work. First, you'll need to preserve some parts of your home so that your mind does not associate them with work. You'll very quickly see that anywhere you work for a few days will be labeled in your mind as office space. So you want to make sure you don't label too many places that way. Choose one spot where you can work comfortably and stay there. Preserve other areas for fun time or quiet time. Also, think about packing everything every evening when you stop working so that you feel like you're getting a break from work and can start fresh in the morning. Your computer is important to think about as well. You might have been using it in the past for entertainment purposes, but it could become a work tool, so you'll need to take action to ensure you can still do the things you like on it without being reminded every other minute of your work. One way to do that is to have different profiles on your computer, one for work and one for your personal life. So in the evening, log off your work profile. When you log into your personal profile, there should be no work applications, work files, or work favorites in your browser. Also, make sure you separate your personal email address from your work one. If you have not done so already, you need to buy your URL or web address at yourcompany.com and put all your work-related conversations on that address. Because you will be doing your work where you live, you need to create clear separations between the two so that you don't end up thinking about work all the time, day and night. There are great technological ways to do that, but also simple things you can do in your day-to-day life so as not to label in your mind everything you see as work-related. There are many reasons why companies look for capital. Those companies can be startups, established companies, or not even companies yet, but just business projects. They can be online or brick-and-mortar companies. They can be technology companies or more traditional ones. But the one thing that those companies share is the fact that they're trying to achieve something and they need capital to achieve it. That something is usually a self-contained project, or in other words, a project that is specific in nature and that is time-bound. For example, the development and launch of a product is a self-contained project that could require capital that the company does not have. The company therefore has either the choice of waiting until it has enough money to develop and launch the product, or to look for capital in order to do that development and launch as soon as possible. Some projects can wait to be started when you have the money, and other projects simply need to be started as soon as possible before the opportunity disappears. For a business project, although it looks like it could be different, given that the company doesn't exist yet, it is pretty much the same thing. A business project is a company that has not started yet and has its founder as its one and only employee. It usually needs to develop and launch its first product, and to do that, it just needs more things than an established company already has, such as office space or employees. In essence, a new product and a new business is pretty much the same when it comes to raising capital. Some of the reasons companies raise capital are the development and launch of a product that requires significant funds upfront. A good example would be if you decide to develop a new product, then need to produce a certain quantity of it and store it until it is sold. The cost of all those steps can add up to a significant amount and therefore requiring you to raise capital. Or to overcome a significant barrier to entry in a market. This can, for example, be seen in the biotech or pharmaceutical industries, where you need to do a lot of research before you get to a product that can be sold. And even then, that product needs to go through many types of approvals and certifications before it can be put on the market. Or also the need to grow the company at a very fast pace to gain a strategic benefit from being the market leader. Let's take, for example, a company that sells a product to the banking industry. Then the company has a quite low number of customers it can sell to. Once its product is ready for launch, the company could need capital in order to put together a sales team that can take over the market as fast as possible before the competition gets in. The benefit here would be to build a stronghold that would be very difficult to take over for any given competitor. You need, though, to be careful to always have a time-bound element to the reason you're raising capital, even if the deadline is very far in the future. An error sometimes made by entrepreneurs is to build a company that requires regular injections of cash in order to survive. A key element of the success of a business is ultimately to be profitable and self-sustaining, which means that once the project for which you're raising capital is delivered, then your company should be able to continue to thrive on its own. In order to raise capital successfully, I think it's important to understand who investors are and what they're looking for when they review business plans. I, of course, won't be trying here to give you a one-line description that will cover all the types of investors, given that each person is unique and has his or her own objectives and way of thinking. There are, though, common traits to many of them, which every entrepreneur would be wise to take into consideration. The first thing is that, despite what people usually think, most investors are or were successful entrepreneurs or had a very high-profile job in a large organization. Many of them have been in your shoes starting projects, raising capital, and they know exactly what you're going through. They also know what it takes to being a successful entrepreneur. They also have seen their share of businesses that failed and are wary of business plans that are too optimistic and of entrepreneurs who are too confident and not ready to hear their feedback. Their feedback is very valuable because investors usually have a great deal of experience starting a business and raising funds. You should definitely hear what they have to say. You could be saving tons of time and blunders by listening to and implementing their feedback. There is one thing they all have in common. They invest in your business to make money, which means getting more money down the road that they have invested at the beginning. And they will not be looking only at your revenue projection, which is sure to be optimistic, but also at what you're going to spend the money on and when you spend it, because those are elements of your business that you can play with and secure and maximize return on investment. Investors all have their unique characteristics and goals, but remember to keep the investor's point of view in mind as you're pitching your project or idea to them. Before you even start meeting with investors, you need to have the answer to this key question: how much capital do I actually need? To answer that question, you actually need to have a very good understanding of how your company is going to make money, how it's going to acquire and retain customers, how much upfront investment is required, how much day-to-day expenses you'll have, any investments you need to make along the way, how fast you'll start seeing your first dollar coming in, and last, how long will it take for your customers to pay you once you made those sales? With answers to those questions and some simple math, you should be able to come up with an answer. One thing you need to keep in mind, though, is that you're going to need much more than your initial investment. Apart from the original investment, there are two things that weigh heavily on your capital needs. The first one is the salaries you'll have to pay, including yours. And the second one is the time it will take to sign your first customer and get paid. If you already have a customer, that's a great way forward and a great way to reduce your capital needs. There are four big sources of capital within which we can fold all the usual sources we know, such as crowdfunding, venture capital, business angels, loans, and so on. Those sources are the following: your own money, money coming from the operations of your company, debt, and equity. Let's look at each one of those in detail. Let's start with your own money. The first question we need to answer is, why are we talking about your money when in the first place you're following this course to understand what other sources of money there are? There are three reasons why we need to talk about your money. The first reason is that we talk about your money, we talk about any money you can get through your own means or can get from your family. So in that sense, it is money that you will have to ask for, just as you would do with investors you don't know. The second reason is that you have to put your money into the project if you want to have credibility when meeting with investors. If you don't put your money into your project, then how can you expect anyone else to put any money as well? How can you convince anyone if you have not convinced yourself? The third reason is that many entrepreneurs don't pay themselves for a few months, and when they can afford it, it can even last for more than a year. And in essence, since they have to pay their personal expenses with their savings, for example, you can consider that it's just the same as investing money into the company and using it as a salary. So if you work for your own company and don't pay yourself any salary or just a very small one and need to compensate with your savings, for example, then you can consider you're investing money into your business. Another great source of capital is the operations of your company. In short, if your company generates a profit, you can use that profit to fund your business and therefore need less money from outside investors. Many entrepreneurs start their company when they found their first customer and can therefore dramatically reduce their capital needs. So the key idea is to keep in mind here that the earlier your company turns a profit and the less capital you will need. Next in line are debts. Usually, people don't like to have debts, but for a company, when you can afford it, it's a great way to find capital without having investors interfering with your business decisions. Contrary to the equity option that we will see in a minute, with debt, it's just like the regular loan you can get for your personal needs. You know upfront how much you get and how much you will pay back. Therefore, there are no surprises. The downside is that you'll have to start paying back from almost day one, which will weigh heavily on your finances. So the more you rely on debt, the more you have to generate revenue fast and in sufficient quantity to pay those monthly repayments. The last big source of capital is equity. Equity means selling share from your company in exchange for the capital you're looking for. You could, for example, sell 40% of your shares for $1 million. You would then have the $1 million you need and will remain the owner of 60% of your company. The upside here is that there is no monthly repayment and the investor is in the project with you for good or bad. The downside is that since the investor is looking to make a big return on his investment, he will be participating to the decisions you make, at least the key ones, and will have a say in your strategic choices. The other downside is that you don't know in advance how much money you will pay back for that investor money. The investor himself will be entitled to a portion of your profits, and down the road, it could add up to much more than you originally received from him. So you'd better be sure that this money is really needed and that you are really getting a great deal. You'll also want to make sure you have tried every other option before resorting to giving away your shares. Depending on your specific situation, you'll have to consider tapping into one or more of the sources of capital. Deciding which one to use and when is a strategy you'll have to define. Raising capital takes time. Not an infinite amount of time, but it usually takes a few months. Between the time that you put together your business plan, define your capital search strategy, start meeting with potential investors, secure the deal, and get the funds, it can easily take 6 to 9 months. What that means is that if your business needs that capital to start its operations, you'd better think twice before you quit what you're doing now, at least until you know when approximately you'll get the funds. It also means that raising capital is rarely the solution to solve an urgent problem. If you need capital right away to save your business or to start it fast to solve a personal situation, then you'd better look for other options that yield more immediate results. Financial statements are documents that summarize all the activities of the company that have a financial impact, and even small ones. The source information of financial statements is the accumulation of all the day-to-day transactions of the company. A transaction is a business event, such as selling products, paying salaries, repaying loans, and of the more infrequent and significant transactions, such as buying an expensive piece of machinery, buying property, or acquiring a company. All those transactions materialize into invoices, paychecks, loan repayments, and so on. All the transactions form the accounting journal. This journal is the list of all the transactions that occurred over a given period of time. You could therefore have a journal for January, for February, for March, and so on. You could have a journal for the full year as well, which would seem to be the aggregation of the monthly journals. Then those transactions are categorized based on their nature and the type of money they represent, such as revenues, costs, taxes, and so on. The transactions are assigned to accounts, where each account covers a single type of transaction. Accounts starting with a 1 are for assets, 2 are for liabilities, 3 is for equity, 4 is for revenue, 5 is for COGS, 6 for expenses, 7 for taxes, 8 for other items. Those accounts are then summarized in the ledger. The ledger is just the summary of all the accounts of the company, which in turn summarizes all the transactions of the company. Each account is specific to one of the financial documents that we will be learning about here. Balance sheet accounts are the ones starting with 1, 2, and 3. And income statement accounts start with 4, 5, 6, 7, and 8. This categorization serves the purpose of giving clarity to what each dollar represents. It is very close to you putting money on the side to buy a present. Well, here it's the same. Some money is due to the tax authorities, some money is due to the shareholders or to suppliers. So by keeping each dollar in a separate account, a business leader can quickly know what is due to whom, including to himself. To summarize, it all starts with a business activity, such as selling a product, which is a transaction. That transaction is recorded in the journal of this month. It is then split into its constituting elements, which are revenue, taxes, and COGS, which are then reported into separate accounts. Those accounts are reported in the ledger, which is then the source of our financial documents. As we briefly saw earlier, the balance sheet is one of the 3 key documents that make up a financial statement. Every company has the obligation to produce a balance sheet at least once a year. This document summarizes everything that the company owns and everything that it owes. Unlike the other 2 reports, it is a snapshot of the company at a certain point in time, meaning that if a balance sheet is prepared on the 31st of December, it is reporting the situation for each category as of that day. Whether that snapshot is completely different from the picture the day before or the day later is inconsequential. It is made of 2 sections called assets and total liabilities and equity. The asset section is focusing on what the company owns. It is the positive side of the balance sheet, and it covers everything that has a tradable value, such as cash, property, machinery, or any money that is due to the company, such as payments expected from customers. If we go back to our ice cream shop example, this includes any money that is on the bank account, the ice cream production machines, the furniture in the store, and the store itself if the company was to own it. The total liabilities and equity section is the flip side of the assets. It is the negative side of the balance sheet and covers 2 areas. The first one, called liabilities, sums up all the debts of the company. For the ice cream shop, it is the loan that was contracted to purchase new machinery, or the refurbishment of the store, or any payment that is due to suppliers. The second section is called equity, and is summarizing the accounting value of the company, which is the accounting value of 100% of the shares of the company. The asset section of the balance sheet, as we saw previously, is containing everything that the company owns. It is the plus side or positive side of the balance sheet. This includes a variety of elements. They all have one thing in common. They have a dollar value and can be turned into cash. Those elements are cash, accounts receivable, inventory, prepaid expenses, net fixed assets, and other assets. Those assets are split into 2 subcategories: current assets, which group together all the assets that relate directly to the day-to-day activity of the company, and fixed and other assets, which are investments that have been made to enable such things as production or having office space. Those are necessary to make the company work, but are not necessarily changing every year. Now let's look at current assets. Current assets is a subcategorization of assets, which groups together all the assets that relate directly to the day-to-day activities of the company. Any event in the life of the company that influences positively and increases its finances and is short-term in nature is going to be a current asset. Generally, the current asset category encompasses all the assets that serve their purpose within the year. Let's start with cash. This is a very straightforward category, as it is equal to the sum of all cash that is available on the bank account of the company. Every time a customer makes a payment, there is money coming to the bank, and the cash of the company increases. Similarly, the cash category of the balance sheet increases. Accounts receivable is the category for any money that is due to the company but has not been paid yet. Let's look at a real-life example. Let's imagine that the ice cream shop just received an order to deliver at the end of the month a large quantity of ice cream for a kid's anniversary. The total amount of that order is $500. The customer is requested to pay 30% of the order upfront and the remaining 70% on the day of the delivery. In other words, $150 today and $350 at the end of the month. In our balance sheet, we will record $150 in the cash category, since it is received today, and $350 in the accounts receivable category, because this amount is due to the ice cream shop but has not been paid yet. When the end of the month arrives and the $350 have been paid, then we will subtract $350 from the accounts receivable category and add that amount to the cash category. The next category is inventory. This is everything that has been purchased to be either sold or transformed before it is sold. For the ice cream shop, any ingredient bought to prepare ice cream would be included in the inventory category, such as milk, fruits, chocolate, and much more. Those are included because once bought, they will be transformed to form an end product that will then be sold. The ice cream shop is selling as well a wide range of soft drinks. Those are bought already in their final form and will not be transformed. Still, when those are purchased, they are included in the inventory category. So every time a soft drink is purchased by the ice cream shop, let's say for $2, it is added to the inventory category until it is sold. On the day it is sold, the $2 are taken out of the inventory category and added to the cash category if the payment has been received on the day of the sale. Or it is added to the accounts receivable category if the payment will occur later. Now let's look at prepaid expenses. It is a category that covers any service that has already been paid but has not yet been received. Examples are any deposits paid to companies, salary advances to employees, or prepayments. As you can see, current assets are relating to the core activity of the company, selling products, increasing inventory, collecting cash. We will speak again of current assets further on, once we have learned about current liabilities and the concepts of working capital. Next are categories of assets that are, let's say, less current. Next, fixed assets is a category that covers the properties, equipment, and more generally anything that is necessary to run the business, but does not vary with individual transactions. You can find in this category one or more offices, production equipment, computers, cars, and so on. Of course, to be included in the next fixed assets category, any item must be fully owned by the company. For example, if the ICS is renting its stores, it is then not the owner of the store. In that case, this is just a monthly expense to the company, and the store value cannot be included in the next fixed assets category. We will see further on where it is recorded. Usually, the next fixed assets category is divided into two subcategories. The first one is called fixed assets at cost, which reports the value of assets at the time of purchase. The second is called depreciation. The notion of depreciation is complex and important to understand. A following video is therefore dedicated to the subject. The last category of the asset section is other assets. As its name indicates, this category covers any asset that cannot be classified in the other categories. A good example of other assets is intangible assets. Intangible assets are assets that do not have a physical presence, such as patents, copyrights, brand names, to name a few. Those assets can have a significant value without which the company would not operate normally, or even would not operate at all. They therefore need to be reported on the balance sheet as assets. Their value, by the way, is very hard to determine and is usually the subject of debates. A good example of intangible assets is the brand name of well-known companies. Think about a large soda company which sells millions of drinks thanks to its brand name. Without that brand name, sales would plummet instantly. It is therefore of high value and needs to be reported on the balance sheet in the other assets category. A concluding note on the order in which cash, accounts receivable, inventory, prepaid expenses, next fixed assets, and other assets are categorized in the balance sheet. At the top, you will find the categories that are the easiest to turn into cash. They are also called liquid assets. Liquid means that it is easy to trade. The categories are then organized from the most liquid to the least liquid. Cash, of course, is the most liquid. Accounts receivable is cash that should be received soon. Therefore, it's liquid, but less than cash. Same goes for inventory. The last category, net fixed assets, is the most difficult to turn into cash, and therefore it appears at the bottom of the assets section. The purpose of depreciation is to account for fixed assets related expenses in a way that is relevant to its contribution to the business activity and not to evaluate the current value of assets. You therefore need to use it as such. To understand depreciation, we first need to look into how the acquisition of fixed assets is accounted for in a company books. When an acquisition is made for a $1 million piece of equipment, for example, it is treated in two different ways in the company books. The two treatments are from a cash standpoint and from a profit standpoint. The first treatment is from a cash standpoint. If the equipment was purchased with cash, then the total cost of that equipment is subtracted from the cash of the company right away. That makes sense. Since the money was spent, it needs to be taken out of the bank account, and therefore to reduce the cash category of the balance sheet. But that same expense is not accounted for the same way when it comes to calculating the profitability of the company. As we will see, when we will deep dive into the income statement, sales or revenue need to be accounted for with its corresponding costs. In other words, if you need to spend money to make a sale, you need to report the revenue from the sale and the corresponding spends at the same time. So when you buy a $1 million piece of equipment that is going to be used for 10 years to produce goods, the accounting standard requires you to account for that equipment every year during its useful life. That's called depreciation. That means that if you use a straight line depreciation for a $1 million piece of equipment with a useful life of 10 years, you will account in the company books an expense of $100,000 every year for 10 years. In the balance sheet, this will represent the loss of value in the accounting books of the company, also called book value, that is recorded over time. To be concrete, after 3 years, the balance sheet will be showing $1 million in fixed assets at cost, since it was the value at which the equipment was purchased, and $300,000 in depreciation, $100,000 per year. The next fixed assets will show a total of $700,000, which is the original value of the asset less the depreciation. As said at the beginning of this video, the purpose of depreciation is to account for fixed assets related expenses in a way that is relevant to its contribution to the business activity and not to evaluate the current value of assets. You therefore need to use it as such. While the concept of depreciation is necessary for the evaluation of profitability, it is not always a good measure of the value of assets and therefore needs to be used with care. Some goods, such as computers for example, lose value over time. After 1 year, a computer can lose as much as half of its value. Therefore, accounting in the balance sheet that it loses a third every year for 3 years can be a realistic measure. On the other hand, some assets have a value that increases over time, and in that case, the next fixed asset value of that asset will not be a good representation of its real value. For example, a property can see its value increase over time due to increased demand for it. Its value in the balance sheet will decrease over its 30 years of useful life, while its real value would increase. The liabilities and equity section covers everything that the company owes to banks, for example, or suppliers, employees, and so on. In other terms, this is all the debts that the company has. Equity is the debt that the company has to its shareholders. It is a very unique type of debt and therefore has its own section in the balance sheet. The equity section contains 2 categories, retained earnings and capital stock. The liabilities section covers all the other debts that the company has, such as accounts payable, accrued expenses, current portion of debt, income taxes payable, and long-term debt. As for the asset section, it is separated into current liabilities and long-term liabilities. Everything that is affecting the company within the year following the day on which the balance sheet has been prepared is reported in the current liabilities section. The rest is considered long-term. Liabilities are all the debts that a company has. Whether it is a loan from a bank, a payment that is due to a supplier, or a salary due to an employee, as long as it is some form of a debt, it will be recorded as a liability. Liabilities are reported just as assets in 2 categories, current liabilities and long-term liabilities. Again, just as for assets, the current liabilities are the ones affecting and being affected by the daily activity of the company. Current liabilities include accounts payable, accrued expenses, current portion of debt, and income taxes payable. Let's look at those one by one. Let's start with accounts payable. This category is for any debt that is due to suppliers. Just as we had an accounts receivable category in the assets section for money due from customers, this section is for money that the company owes to its suppliers. Most companies negotiate payment terms and will receive from their suppliers the possibility of paying a certain number of days after having purchased a good or a service. The most common payment terms are prepaid, which means the company needs to pay its suppliers before the good is shipped or service is rendered, and 30 days net, which means the company can pay 30 days after the invoice date. During the time between the purchase and the payment, the money due to the supplier will have to be put on the side. It will be reported in the accounts payable category. For example, let's say the ice cream shop decides to purchase on the 15th of April new tables and chairs for its store to make it nicer for a total value of $3,000. Let's say as well that its supplier, a furniture store, agrees to give the ice cream shop a 30 days net payment term. That means that even though the order was placed on the 15th of April, no payment will be made until the 15th of May. On the 15th of April, even though the payment is not due for another month, the ice cream shop will have to put the money on the side until the payment is made. During that time, the money will be placed in the accounts payable category. Now, income taxes payable. Income taxes payable is again a debt, but this time to the tax authorities. Company taxes are paid every 3 months. There is therefore a time difference between the moment that a profit is made and the time that taxes are paid. During that time, the tax money is put on the side, in the income taxes payable category. On the day of the payment, that amount is taken out of that category, since the debt then no longer exists. Next in line is accrued expenses. Accrued expenses is reporting any money that is due to stakeholders other than suppliers. As we saw earlier, suppliers have their own category for that type of debt, which is accounts payable. For example, an employee is one of the stakeholders that can be covered by this category. Let's say the ice cream shop has a bonus plan in place to motivate its employees to sell soft drinks. And let's say the bonus is paid only once a year. Let's imagine then that John, an employee of the ICS, has made a terrific job selling soft drinks and by April has already earned $500 worth of bonus. As the bonus will be paid only at the end of the year, the ice cream shop accountant will have to put those $500 on the side for a later payment. Until the end of the year, the $500 will be placed in the accrued expenses category. The last category of current liabilities is current portion of debt. This category is for the portion of loans that is due within the coming 12 months. To be concrete, if your company has a 4-year loan in place and it needs to pay $5,000 per month for 48 months, we will be reporting only the next 12 months in the current portion of debt category. In other words, 12 times $5,000. The remaining 36 payments will be reported in the long-term debt category. Only the current portion of debt category will be reported in current liabilities. The last liability category is long-term debt, which we just saw. It's covering the portion of loans that is beyond the next 12 months. Equity is a category that covers yet another debt of the company. That debt is specific in nature, since it is a debt towards the owners of the company, also called shareholders. I remember that the first time I got introduced to the concept of equity being a debt, I was really surprised. The main reason was that for me, if the company was mine, there could be no debt between me and myself. And in fact, it's not the case. To understand the nature of equity, it is important to understand that when a company is incorporated, a new person is created, in the legal sense at least. The new person is called a juridical person and has a legal life of its own. The company, being a juridical person, has rights, obligations, and responsibilities, and as such, has a life of its own, separate from the person who raised it. Therefore, when a company is incorporated, it is a different person from yourself, which poses the next key question. What's the relationship linking you to your company? The link is the following. When you raise a company, you lend money to your company, that new juridical person. The company will use those resources to conduct its activities with the objective of generating a profit. Just as a bank lends you money that you pay back with interest, you have lended money to your company that you will get back with interest as well. The company owes you the initial investment plus compensation. In accounting terms, the capital you invested in the company is worth a certain percentage of the company and can go up to 100% of the company if you are the sole owner. This capital is the equity. Since the company owes you that money, it is indeed a debt towards you, the shareholder. You might ask, what about the compensation? Well, in accounting terms, we call those dividends. And if the company makes an annual profit, you will get a share of it. That's the part of your compensation that relates to your investment. That category is divided into two subcategories, which are capital stock and retained earnings. Capital stock or common stock is the total amount that has been invested by the shareholders. If 3 people bring $2,000 each to raise a company, then capital stock is equal to $6,000. Retained earnings is a category that reports the accumulation of all the profits that the company has generated. When bills are paid with company money and not new loans, the money comes out of the cash category on the assets side and correspondingly reduces the retained earnings category on the liabilities and equity side. At the end of the year, if there's any profit left in the retained earnings category, it is distributed as dividends to the shareholders. If you ever wondered where the name balance sheet comes from, the explanation is coming from the fact that the two key sections of the balance sheet, assets and liabilities and equity, must always be equal to each other, or in other words, be in balance. If that is true, it means that all the assets or everything the company owns must be equal to the total amount of what it owes. The reason for that is that the company in itself, being a juridical person and not a physical person, cannot ultimately own anything for itself. It therefore does owe whatever it owns to someone else. First, it owes money to lenders. As it has received cash from banks and other lenders, a portion of what the company owns belongs to them, at least until the loans have been repaid. If there's anything left, it is owed to the shareholders, the true owners of the company and of its value. There's a formula that summarizes this well, and it is assets is equal to liabilities plus equity. Another way to look at it is to say that if the owners of the company decide to sell all the assets and repay all the debts, then any leftover money will belong to them. In other words, equity is equal to assets minus liabilities. Let's take now some live examples to illustrate this important concept. My first example, if you put your own money into a startup company, let's say $10,000 in cash, and make $25,000 out of it, then you have more than doubled your money. Your equity is worth now $25,000, the same as your assets. If we look at the asset formula, you have now $25,000 of assets, which is equal to 0 liabilities, plus $25,000 of equity. If we look at the equity formula, $25,000 of equity is equal to $25,000 of assets, minus 0 liabilities. For our second example, let's say you borrow $10,000 and make $25,000 out of it. Then, you truly made only $15,000, since ultimately you will have to repay the loan. Your assets are worth $25,000. Your liabilities are worth $10,000. Therefore, your equity is worth $15,000. From an asset formula standpoint, assets equal $25,000, which is equal to $10,000 of liabilities plus $15,000 of equity. From an equity formula standpoint, equity is equal to $15,000, which is equal to $25,000 of assets minus $10,000 of liabilities. As a third example, let's say you borrow $10,000 and spend it all with no return. Then, not only have you lost all the assets of the company, but you will also most likely have to repay the debt. You have no assets left, liabilities are $10,000, and therefore your equity becomes a negative $10,000. If we look at it from an asset formula standpoint, assets is equal to 0, which is equal to $10,000 of liabilities minus $10,000 of equity. From an equity formula standpoint, equity is equal to minus $10,000, which is equal to 0 assets minus $10,000 of liabilities. Now let's take a few business situations and see how they impact the balance sheet. Let's start with investing. So you just decided to start a new company and to invest $10,000 of your own money. You put that money on the company bank account, which automatically increases the cash account on the asset side of the balance sheet by $10,000. At the same time, the company now owes you $10,000. We therefore increase the capital stock category on the equity side by the same amount. You actually need $15,000 more to start your operations and ask the bank for a loan. The loan is granted and you get $15,000 more on your bank account. Again, this gets added to the cash category of the balance sheet, totaling now to $25,000. You now have a new debt of $15,000 and need to add it to the liabilities side. The loan you have contracted is to be repaid during the next 3 years. You therefore put 1/3 of that loan on the current portion of debt category. This is the portion that will be repaid in the first year, and the rest goes to the long-term debt category. That money is needed to start production. You therefore decide to use $8,000 of that money to buy a piece of machinery. You therefore pay those $8,000 and reduce the cash category by that amount. Here, you use it to buy an asset. You therefore impact only the asset side of things. The reduction in cash is here offset by an increase of the net fixed asset category. Your balance sheet is still in balance. Let's get now into production. Now that you have your piece of machinery, you need to buy raw material. You spend another $2,000 on raw material, which reduces further your cash. If you remember, you started with $25,000 and purchased equipment for $8,000, leaving you with $17,000. With that new spend, you're left with $15,000. Again, on the asset side of the balance sheet, you have now $2,000 worth of raw material. This raw material is in your inventory, which therefore calls for increasing the inventory category by $2,000. With the raw material and machine, you transform the material into a finished product, ready to be sold. This transformation will have no visual impact on the balance sheet, but in the details, the $2,000 of raw material will be replaced by $2,000 of finished goods. Let's get now into selling. So you're now ready to sell goods to customers. You sell them for $3,000. The customer requests to pay in 30 days, and you accept the term. The $2,000 inventory is now sold to the customer, and the inventory category therefore goes back to zero. The $3,000 are added to the accounts receivable category on the asset side. The net impact on the asset section is an increase in $1,000, since you have sold for $3,000 goods that you paid for $2,000. You have increased the value of your assets, and therefore the value of your company. You can therefore increase retained earnings on the equity side of the balance sheet by $1,000. The balance sheet is again in balance. 30 days later, the customer pays the $3,000 bill. So you can take out $3,000 from the accounts receivable category and increase the cash category by the same amount. Let's get now into paying stuff. The end of the month is coming. Did I tell you that you have one employee? Well, you need to pay her or his salary of $1,500, which includes $300 of employee contribution, and to which we need to add another $500 of employer taxes. To do so, we take out $1,200 from the bank account to pay the salary and reduce the cash category by that amount. On the liabilities and equity side, we increase the accrued expenses category by the $300 of employee contribution, as well as the $500 of additional taxes, to keep that tax money separate until the payment is made to the authorities. The salary and taxes that you paid will then have to come off the retained earnings category. The balance sheet is again in balance. The income statement is the second key document of the financial statement. Its purpose is to report on the business activity of the company. To be more precise, it focuses on the sales that have been made and the expenditures that have been necessary to fund the daily activities of the company. And it concludes with the resulting profit or loss that has been made. This is the reason it is usually called the P&L, where the P stands for profit and the L stands for loss. The income statement reports on the business activity over a certain period of time, which means that it will report all the sales and expenditures activity between a start date and an end date. As an example, a 2012 income statement reports all the sales and expenditures between the 1st of January and the 31st of December. A 2013 first quarter income statement could report the activity between the 1st of January and the 31st of March. I'm saying could report, as some companies have a fiscal year that starts at a different time than the 1st of January, and their quarters are therefore not the same as the calendar year quarters. The income statement has a set of categories that we will be reviewing individually. Those categories are revenue, costs, gross margin, operating expenses, operating income, non-operating income and expenses, and net income. Now let's talk about revenue. So revenue, or income, or sales, are all words that describe the same thing. When a company wins new business, it goes through a set of actions to fulfill the request of the customer, and it results with an obligation for the customer to pay for the good or the services provided by the company. Revenue can have different names such as turnover or top line. That last name, top line, comes from its position within the income statement. As it is the first line of the income statement, it's the top line. To understand what exactly revenue is, it is important to understand the complete cycle of a sale. The usual steps are an initial discussion between the company and the customer. The company issues a quote to the customer with the price requested to render the service or provide the good. Negotiation between the customer and the company happens. The final quote is sent to the customer approves the quote, the company sends an invoice to the company ships goods or renders a service, and the customer pays the invoice. The last three steps sometimes happen in a different order, depending on the situation. The reason it is so important to understand the cycle of a sale is because that sale becomes revenue only when the invoice is issued. Before that time, it's just a discussion between the customer and there is no true commitment. Once the invoice is issued, there's a formal agreement between the company and the customer, which will be followed by a payment and the shipment of goods or rendering of service. In the example of the ice cream shop, most of the steps happen, even if they do in a very short period of time. A customer enters the shop, he checks out the ice cream prices on a board or on a menu. He could ask for a discount, but for a simple ice cream you might not accept to offer a discount and will confirm to the customer that the price will remain unchanged. The customer can choose to accept that price. In that case, you will first prepare and provide the ice cream. The customer will pay and you will give him a bill. In the case of the ice cream shop, you will have to wait until the last steps to account that sale in your revenue. To link this back to what we have learned on the balance sheet, once the invoice is issued and therefore the sale is made, the customer either pays right away and the cash category increases, or the customer is due to pay in the near future. And in that case, it's the account receivable category that will be increased. If it's a good that has been shipped, then the inventory category will decrease as soon as the good will come out of the inventory to be shipped to the customer. So what's the difference between revenue and cash? The income statement reports revenue, while the cash flow statement reports cash. The big difference between the two is the payment. As we have seen previously, the generation of revenue occurs when the invoice is sent and until the payment is made. A debt exists between the customer and supplier. When you eat at a restaurant, for example, at the end of the meal, the check is brought to you. In accounting terms, the restaurant gave you an invoice. During the 5 minutes between receiving the check and paying it, you actually owe money to the restaurant. During those 5 minutes, the restaurant has generated revenue equal to the amount of the check, but no cash, since you have not paid. In accounting terms, again, the revenue is recorded right away on the income statement as revenue and in the balance sheet as accounts receivable. If you remember, this is the category for money owed by customers to the company. At the end of those 5 minutes, you pay the bill and are longer indebted to the restaurant. There is no change to the income statement, but in the balance sheet, the amount of the check is removed from the accounts receivable since your debt has been repaid, and that same amount is moved to the cash category. The restaurant has now earned cash. Of course, in this example, it all happens in 5 minutes, and in the company books, it will be reported as having happened at the same time. But companies have access to a large variety of payment terms, which create a significant time difference between the invoice date and the payment date. Payment terms start with prepayment, which require the customer to pay on the invoice date. It can also have many forms, such as payment 30 days after the invoice date, called 30 days net, 60 days after the invoice date, called 60 days net, at the end of the month, called end of month, on the 15th of the following month, called end of month, the 15th, and so on. There's no limit to the creativity of companies when it comes to payment terms, and it can go as high as 120 days after the invoice date in some countries. This means that if your company has offered a 30 days net payment term to a customer, you will have to deliver the good or render the service and wait 30 days after the invoice date to collect the money. The money, as we have seen, is due to you on the invoice date, but the customer owes you the money during those 30 days. In essence, you're lending money to your customer for 30 days. That also means that during those 30 days, you will not be able to pay your bills with that money, even though you earned it, until it is paid to you. In the income statement, all the expenditures of the company are divided into two categories: costs and expenses. A company needs to spend money in order to operate on a day-to-day basis. Those expenditures enable a wide variety of activities, ranging from the fulfillment of customer orders to paying salaries, furniture, rent, utilities, and many more. In the income statement, the expenditures are divided into two categories to give the reader the ability to differentiate between the costs of products from the rest of the expenditures. Let me explain why with an example. Let's imagine that the ice cream shop has been making good money for some time now and that the owner wants to stop renting its shop and buy it. The ice cream shop owner will speak to its banker, and because it is a well-managed company making good profits, it will get a loan to buy that shop. Once the shop is purchased, the ice cream shop will start repaying the loan on a monthly basis. Each month, it will therefore be making less money, since it has new expenditure to pay. But if you step back and analyze the financial health of the ice cream shop, would you say it's not as well managed a company as before because it's making less money than in the past? With no visibility on the details of why it is making less money, you could be tempted to just conclude that. The income statement has therefore a category for product-related costs, so that you can make the difference between how the business is run and how the company in general is run. For our ice cream shop example, you would therefore see that the money made from selling ice creams and other products is still the same, and the company is as well managed as it was in the past. It's making now less money than in the past due to an increase in expenditures that are not related to the business activity. Cost is the name of those expenditures that are related to products. It is usually also called cost of goods sold, or COGS for short. What we mean by that is that to sell a product to a customer, you need to put that product together. There's the raw material, the machinery, the salaries of workers. In other words, everything that we need to prepare that product. For the ice cream shop, this is the milk, sugar, eggs, and many more ingredients. It's the cups in which you hand the ice cream to the customer, it's the paper napkins, and anything that comes into the fulfillment of the orders of your customers. As explained in a previous video, the income statement is reporting the activity for a given period of time. Record the costs becomes important. Do you record the cost of producing goods at the time of production, or do you do it at the time of the sale? If you have produced 100 pounds of ice cream in December 2012, do you record it in 2012, or do you record it in 2013 when the ice cream was actually sold? The answer is unambiguous. It's at the time of the sale. In accounting, we like to have our revenues and our costs reported together. It's interesting to note that you have produced ice cream in December 2012. You have therefore already spent the money to buy all the ingredients and so forth, but while you have spent the cash, it is not yet the time to record the cost. In accounting terms, in December 2012, it will mostly be the balance sheet that will be affected, as cash will be spent to prepare an inventory of ice cream. In other words, the cash category of the balance sheet will decrease by the amount spent, and that amount will be moved into the inventory category. And it will stay there until the ice cream inventory is sold. When an ice cream is then sold, we will record in the income statement the revenue and the cost associated with that sale. If we go a step further in that logic, the consequence on the balance sheet will be to decrease inventory for that ice cream we just sold and increase cash for the payment made by the customer. Of course, we want to sell our products with a profit, which means that the revenue of the sale needs to be greater than the cost of it. If you follow me, that means that the cash increase in the balance sheet will be greater than the decrease in inventory. The net effect of that is that overall, assets will be increased. If you think about it, it's quite logical. Each time you make a profit, your assets increase and the value of your company increases as well. Let's make a pause here in the review of the income statement to define one of the most important concepts in finance, and maybe the most important for our discussion here: profitability. Profitability is the difference between the money that comes into the company from sales and other money-generating activities, and the money that comes out of the company as expenditures. In other terms, to ask about the profitability of a company is the same as to ask if the company is making money. Is my company profitable? Is it making money? If yes, meaning if you generate more money from your business activities than you spend, and you have money left in your pocket, or rather in the company's pocket, then yes, your company is profitable. If not, that means your company spends more money than it earns, and it is therefore not profitable. It is generating a loss. This is a dire situation for a company to be in, which requires immediate action to avoid bankruptcy. In the income statement, we calculate different types of profitability, even though ultimately there's only one form of profitability, which is the one that includes all revenues whatsoever and all expenditures whatsoever. For us to understand the workings of a company and take actions that will help the company to progress positively, there's a need to calculate other forms of profitability, such as the profitability from production activities or the profitability from business activities, and ultimately the overall profitability of the company. The profitability from production activities is measured by the gross margin and focuses on your products or services. The profitability from business activities is a bit wider in definition. It is measured with the operating income. It includes the gross margin plus operating expenses. The last one, and true profitability of the company, is measured by the net income and is the one including all the elements above plus any remaining revenues or expenditures that are not related to the operations of the company. We will be reviewing each one of those in the chapter ahead. There's a famous saying that goes like this: revenue is vanity, margin is sanity, and cash is reality. What it means is that however big the revenue of a company is, it gives no insight whatsoever on its financial health. Of course, it's impressive to be able to generate millions or billions of dollars in revenue, but focusing only on that element is a dangerous game. If the cost of running your business is as great as your revenue, then the company generates no profit, and the owners of the company, the shareholders, get no return for their investment. Even worse, if there's a downturn in the economy, as we've experienced in the recent years, the company will then be the first one to be at risk of defaulting. So this is why margin is sanity. Making sure you generate a profit is the guarantee that you're not just working to pay the bills. You actually generate extra money that can be used as a compensation for your investment, such as dividends, or reinvested in the development of your company. As I'm sure you already got why cash in your pocket is reality, let's focus here on the concept of margin, and more specifically, gross margin. Gross margin is the result of a simple subtraction: revenue minus costs. So to have any gross margin, you need to generate more revenue selling your products than you spend making them. When you look at your revenue solely, you can see if you're progressing with sales increasing month over month, or if you have a decrease and need to work on changing the trend. But costs on their own are not necessarily a good measure either of how good your performance is. Costs could be increasing for many reasons, such as increasing the cost of materials. For the ice cream shop example, that could be your milk increasing, or simply because sales have gone up and you therefore have more ice cream out of your inventory. This is where gross margin comes into play. As gross margin is the combination of revenue and cost, it gives you the ability to estimate if your overall business performance is good enough. If an ice cream is sold for $5, and if it costs $3 to produce, then your margin is $2, $5 minus $3. If you sell 2 ice creams, then your revenue is $10, your costs $6, and your margin $4. In other words, if each of your sales are generating margin, then an increase in sales results in an increase in gross margin. In our example, when sales double, margin doubles as well. Gross margin is usually displayed in 2 forms. Its dollar value, as we've just seen in our example, and as a percentage of revenue. In this example, the margin percent on an ice cream is calculated by dividing $2 by $5, which is equal to 0.4, or 40%. If we calculate the margin percent for the 2 ice creams sold, we divide $4 by $10 and get again 40%. And we could sell another 100 ice cream and our margin percent would still be 40%. The benefit of tracking margin percent becomes obvious when complexity increases in a company. In our example, things are maybe too simple. Businesses have usually more than one product: high margin products, low margin products, and sometimes cost of production increases because the price of ingredients increase or decrease because the company is now using more efficient machinery. All those elements and actually many more, will have an influence on the evolution of revenue and the evolution of costs, and they will all be summarized in the gross margin percent. If, for example, you sell an ice cream for $5 with a soda for $3, then your total sale will be $8. If the cost of making the ice cream is still $3 and the cost of the soda is $1, then the margin on your ice cream would be $2 and on the soda would be $2 as well. The resulting total margin for the order would be $4. In percentage terms, the margin of the ice cream is still 40%, when the margin of the soda is 67%. The resulting margin is 50%. If we compare that to our previous example, we have generated less revenue going from $10 to $8, but we generated just as much margin. The reason being that we sold this time the soda, which is a higher margin product. The overall result is a higher margin percent going from 40% to 50%. The analysis of margin gives great insights into the performance of the company. Outside of showing if the company is making profits, its evolution can be explained by a large number of factors that are affecting both revenue and costs. It is by investigating those factors that we get a good understanding of what is working and what's not working in the business performance of the company. Operating expenses, also called OPEX, are that second kind of expenditures. Those expenditures are key to the operations of the company, but are not specific to products. They include compensation and benefits for non-product related staff, marketing spends, communication spends, travel, rent, utility bills, and so on. Added together with costs, they form the expenditures of the company that are related to running the business. Operating income, called as well OPINC, is, just as gross margin, the result of a subtraction between revenue and expenditures. The major difference with gross margin is that it includes more expenditures. As we have seen earlier, gross margin is the difference between revenue and costs and is specific to the activities around selling products or services. It is the production, in a wide sense, related profitability. Operating income is a wider type of profitability as it includes as well all the operating expenses. It is therefore the profitability of running the business in a general term. You can calculate it using one of the following formulas. Operating income is equal to revenue minus costs minus operating expenses. Or operating income is equal to gross margin minus operating expenses. Your production could be profitable, but not your business. For example, selling ice cream could be profitable, but not enough to cover all of the expenses of your business. You could be selling ice cream for a higher amount of money than it costs you to produce it, which would make it profitable from a production standpoint, but you could have a rent that is too expensive or too many employees for a business of your size. The result would be that your operating expenses would be using up all the profits generated with your production of ice cream and leaving your company with a loss. In such a case, you would have to consider either to increase prices to generate more margin or to reduce your expenditures, whether it be by negotiating with your supplier for lower prices on ingredients or through moving to a smaller shop. Operating income is therefore a tool that you can use to review if your business is healthy and if its operational activities are profitable. Again, as for gross margin, the operating income of a company is usually measured in both dollar value and percentage of revenue, as it is as important to ensure the value is at least positive and to ensure that the operating income of the company is relevant to the amount of revenue generated. If last year, for example, you generated $5 of operating income for each $100 of revenue, or in other terms, 5% of OPINC, and this year you generate $7 of OPINC for $200 of revenue, or 3.5%, then you're indeed making $2 more profit compared to last year, but in percentages, or relative terms, you're making less OPINC than last year. This in itself is not necessarily a bad sign, but it requires further investigation in order to understand the source of it. It could be that this year, one of your lower margin products just picked up in sales, and that it overall reduces your relative OPINC to revenue. Up to now, we have seen all the aspects of the income statement which relate to the operations of the company, but some of its income and expenditures can have their source outside of the operations of the company. Such elements could be, for example, taxes paid to the relevant authorities. This is an expense that's not done with the purpose of generating business or maintaining business, but rather to fulfilling a legal obligation. It is therefore reported below the operating income line. You can find as well their interests paid on loans or interests received on money left on a saving account. In general terms, this section will cover the inflow or outflow of money that is due to non-operational activities. You can also find here any element that is not related to the normal activities of the company. For example, you will find there transactions that are significantly more important in dollar terms than your normal activities, such as acquiring a company, or selling part of your company, or the consequences of events that are out of the ordinary, such as the impact of an earthquake, for example, on your business financials. Net income is the last line of the income statement, and as such, it earned the name of the bottom line. It is indeed the bottom line of your company, and where you can see if you're making any money, some money, or good money. It is one of the most important aspects of your business, and definitely the most important one of the income statement. It is the element of the income statement that needs to perform well, and which you need to focus on by analyzing its underlying elements, such as revenue, expenditures, whether operational or non-operational, to get it to the expected level. Net income is how much money the company is making over a certain period of time, and it is very different from cash. Net income is money earned, but not yet paid, and true money made is money in the bank. To go back to the expression, revenue is vanity, margin is sanity, and cash is reality. Only cash is reality. We will deep dive into that topic in the next chapter. Now let's take a few business situations and see how they impact the income statement. Let's start with selling products. As you sell a new product, you invoice the customer by giving or sending him a paper or electronic invoice. This triggers automatically the addition of the revenue and costs associated with that order to the income statement. The revenue is added to the revenue line and the cost to the cost line. Now let's take this example a step further and consider the impacts on both balance sheet and income statement. As you invoice your customer, the revenue side of the invoice is impacting the income statement by increasing the revenue line. On the balance sheet, it's impacted first on the asset side by the increase of the cash category as soon as the payment is made. On the liabilities and equity side, the sale you just made will impact retained earnings and income taxes payable. On the cost side, the same sale will impact the income statement by increasing the cost line by the cost associated with that sale. On the balance sheet, in the asset section, the same cost will be deducted from the inventory category. As you sell a good, you take it out of the inventory and give it to the customer. So in the same way, it's taken out of the inventory category of the balance sheet. On the liabilities and equity side of the balance sheet, it will reduce retained earnings. Also note that at this point, the balance sheet remains in balance. Now, let's look at paying bills. As you pay your bills, it can either be for production purposes or other general expenditures, or even for buying fixed assets. We have seen in the previous example how production expenditures are handled. Let's see now the cases of general expenditures and fixed asset purchases. For general expenditures, let's say that you need to pay for sales flyers. As you will receive the invoice from the manufacturer, you will send him the money by writing a check, by cash, or by wire transfer. In any case, the amount will have to be added in the income statement to the expenses category. In the balance sheet, that same amount will be deducted from the cash category on the asset side and will reduce retained earnings on the liabilities and equity side. For fixed asset purchases, you need to recall what we learned about depreciation in the balance sheet chapter. As a fixed asset is purchased, it's accounted for differently from a cash standpoint and from a profit standpoint. From a cash standpoint, on the day of the purchase, the total amount of the purchase is deducted from the cash category of the balance sheet. And the same amount increases the net fixed asset category, and within the net fixed asset category, it is entered in the fixed asset at cost subcategory. Once that is done, every year, the asset will get depreciated by a portion of its value. This year's depreciation will be added to the accumulated depreciation subcategory. In total, the net fixed asset category will decrease by the newly depreciated amount. On the income statement side, that depreciation for the year will be taken into consideration. If you remember, when the asset was first purchased, there was no impact to the income statement. And of course, it needs to impact at some point the profitability of the company. Well, that's when it does. Once the asset is depreciated, the depreciation amount is included in the income statement as an expense. It therefore reduces the income or profits of the company by that same depreciated amount. The cash flow statement is the last document of the financial statement and is the one that is the most grounded in reality. Here, there's nothing more to know than if money is or is not in the bank. You could wonder why there's a need to have such a document when you already have a bank statement, a balance sheet, and an income statement. Well, first of all, the income statement does not report cash, it reports revenue. It reports income, but not cash. For the bank statement and the balance sheet, which do report cash, it is done in a way that does not give a sufficient level of detail to enable a good understanding of the key levers the company needs to use to ensure its success, and sometimes its survival. In the cash flow statement, cash is reported over a period of time, a year for example, and you can follow its evolution between a starting date and an end date, just as the 1st of January up to the 31st of December. In a cash flow statement, the main categories are the beginning balance, cash from operations, fixed asset purchase, net borrowing, income tax paid, sale of stock, and the ending balance. The biggest reason for having a cash flow statement is that there's a big difference between the accounting view of the company and its cash reality. Both views are correct and useful to managing the company, and both show the company through different lenses, which complete each other. The profitability of the company is, as we've seen, the difference between its revenue and its expenditures. In the income statement, we always assume that they both happen at the same time to ensure we can review the profitability of each of our actions. But when it comes to spending money or collecting it, the timing of it can be, and usually is, very different from that income statement view. To sell your products, you need to purchase material and produce goods well in advance, which therefore implies that you have actually spent the money well before it is accounted for in the income statement. And as we have already seen, revenue is very different from cash, which can be received a long time after the sale has been made. As a concrete example, if you produce your goods 1 month before selling them, and you receive payment 1 month after selling them, you can end up with 2 full months between the time you invested the company's money and the time you get the return. During that time, you need to be able to continue to fund the operations of the company, either with money that has been saved or with a loan, and the bigger the orders you receive, and the more the situation creates pressure for the company. If you think of it, this is critical for successful companies that can receive increasing orders as they become more successful and need to find a way to fund the gap that exists between production and payment. This is why it is sometimes necessary to find financial partners to help you go through that high pressure time and not turn down orders. It is therefore critical for a company to be able to manage its cash and have a thorough understanding of its inflows and outflows of money. Gaining that understanding enables the company leaders to understand what its vulnerabilities are and to take appropriate actions well in advance of their occurrence. Now let's look at the cash flow statement in detail. Compared to the balance sheet and the income statement, the cash flow statement is quite simple. It is reporting the inflows and outflows of cash from the company by breaking it down into big categories. It's starting from the beginning balance and ending with the ending balance. The beginning balance is the cash position at the start of the reported period. The cash position is a fancy name for the balance on your bank account at a certain date. If you are looking at a cash flow statement for the past year, then it is the cash position as of the 1st of January of that year. And in the same logic, the ending balance is the cash position at the end of the 31st of December. The beginning balance is always equal to the ending balance of the previous period. This year's beginning balance is therefore equal to the ending balance of last year. To walk from the beginning balance to the ending balance, we start with the first category, which is the cash from operations. Cash from operations is the cash that comes from running the business. It is the cash from sales, the cash from purchasing material, paying salaries, rent, paying anything that is related to running the business. Then comes fixed asset purchases. A time will come when you will need to invest in new assets, such as replacing machinery or buying property. Even though that is a key element to running a company, it is not a day-to-day activity and is therefore reported in a different category that is dedicated to purchasing new assets. To do that, you will sometimes have to take loans which will inject cash into your company. That cash is not generated by your activity, but will help you go through tough times and make an investment that would otherwise have required you to save money for years before making it. The cash coming from those loans are reported under the net borrowing category. Next is taxes paid. This one is very straightforward. It is the amount of taxes that the company paid. The last element is sale of stock. This is another mean to bring cash into the company. Selling stock to new investors is a way to bring new funds which most of the time will be used to develop the company further. That cash is reported under the sale of stock category. The cash flow statement ends with the ending balance, which is the beginning balance plus all the money that came in minus all the money that came out. In other words, beginning balance plus or minus cash from operations plus or minus fixed asset purchases plus or minus net borrowing plus or minus taxes paid plus or minus sale of stock equals ending balance. It could seem surprising to have both plus and minus for all those items, but you need to remember that each of those categories can report a vast number of situations. For example, if the amount of debt that you're paying back is bigger than the money that you borrow, then you could have a negative amount for net borrowing. The same goes for purchasing or selling assets, selling or buying stock, or having a tax refund. Yes, it does happen. I'm sure we will all agree that more cash is better. And when we read a cash flow statement, we can be tempted to view a negative cash flow as bad news. We need to be careful not to make hasty conclusions. As we have already seen, the cash flow of a company is made up of many inflows and outflows of cash. When a company invests in its future by purchasing machinery, property, patents, or even other companies, it can be spending a lot of cash to do so. This will therefore reduce the cash position of the company and could create a negative cash flow. In that case, it's clear that it is negative cash today due to an investment that is expected to bring more cash in the future than if the investment was not made. In this case, a negative cash flow is far from being bad news. It's therefore very important to look in detail into the cash flow statement categories to understand the source of a reduction or of a negative cash flow. If it is due to the operations of the business, then it could be critical to the survival of the company. If it is due to more investments or the repayment of loans, then it could be a positive sign. I've already partly made this point earlier, but it is so important that I think it is worth spending a bit more time on the concept of analyzing for decision making. There are many benefits to analyzing the performance of a business, but like every other activity, it has to add value to the company. When you run a business or a department within a business, or your own scope within a department for that matter, you will probably be overflowing with questions you're asking yourself which, if answered, could help you improve the performance of the company. The temptation then is to try to answer them all and spend a significant chunk of your time analyzing your business. While all those questions surely seem interesting and charged with added value, most of them will not lead to concrete actions to improve the business. Why? Simply because not all of them have at their source a problem to be resolved. Every company, every day, has a set of problems to resolve. Those will always have priority over everything else. Other people within the company will acknowledge the importance of solving those problems and will support and prioritize any action or analysis that helps in finding a solution. So next time you sit down to analyze your business, ask yourself if it is helping to resolve a problem and will lead to concrete actions. Most questions that start with, why is this or why is that, usually don't lead to actions because they seek understanding of a situation. Questions that start with, how can I, how can we, for example, are focused on the need to do something and are therefore likely to lead to concrete actions. Any analysis that helps in answering those questions will surely add a lot of value. need to do is to make sure we have a good understanding of what we are talking about. So what is an investment? The most common definition of an investment is that someone is spending money or putting aside money for a certain period of time in order to get back more money than he or she originally invested. If we analyze the definition in detail, we can identify 3 key elements and 3 keywords. The first one is that there is an original sum of money that will be spent or put aside, which is called the capital. The keyword here is capital. The second is that time will play a part in it. No matter how long or short that time is, the keyword here is time. The last element is that at the end of the investment period, you will be getting something back from your investment. It is called a return. And the keyword here is return. It is by the analysis of those 3 elements, capital, time, and return, that you can differentiate good investments from bad ones. This definition is, as I said, the most commonly used. In reality, an investment has a much broader meaning. First of all, it's not limited to money. Of course, many investments involve money in one form or another, but there are many other types of investments out there. Let's look at our 3 keywords to dig deeper into that thought. Let's start with capital. Capital, sometimes also called the principal, is an asset that you possess and that you can dedicate to an investment opportunity. It can come in the form of money, time, a machine, an office, a vehicle, a patent. It is pretty much anything that you can own and that has a value. Maybe you're asking yourself, why is time in that list? After all, does time have a value? Let me answer that question right away. Yes, time does have a value. The way to look at it is that when you dedicate your time to an activity or to an investment, you are preventing yourself from doing something else, such as making money, for example. Therefore, by investing your time, you have decided to cut yourself off of a source of money, and in essence, it is not much different from spending money. Now let's discuss our second keyword, time. Or actually, let's not discuss it. After all, time is what it is. Whether it is for just 1 second or 10 years or even more, there is nothing more to it. The third keyword is return. Just as for capital, a return can come in many forms. It can come as money, time, machinery, office space, and pretty much anything that has a value to you. So what we just learned is that an investment can involve anything that has a value, not just money, and can return anything that has a value, again, not just money. It is also interesting to note that the nature of your capital can be different from the nature of your return. For example, you can invest time and get money back in return. A good investment is much more than just getting a positive return on an investment. If, for example, you invest $100,000 for 10 years and get $100,001 in return at the end of that period of time, I bet you will question whether that investment made sense in the first place. And you know what? I'm completely there with you. Investing $100,000 is a very significant amount of money, and it is not worth your while to invest it on a project that produces a single dollar of return over the course of 10 years. The first reason why we intuitively understand that this is not a good investment is because we know we could have made much more money by investing it somewhere else. And that is the first additional criteria to making a good investment decision. To make a good investment, we must compare the investment opportunity to other comparable opportunities to make sure we put our money in the right place. As a simple example, anyone can have a saving account, and usually the interest rate on those accounts range from 1% to 2% per year, and sometimes a bit more. Let's assume here our saving account generates 2% interest per year. By putting our money on a saving account, we know for sure we will be making a 2% return per year. Knowing that, why would we want to take on a project that yields anything less than that? Another aspect of making an investment decision is the level of risk associated with the project to be undertaken. Not all projects yield a positive return, and many projects have a potential to make you lose money. Buying stocks, for example, on the stock exchange holds no guarantee of seeing any money back. So if, for example, you had an opportunity to invest your money on a project yielding a 2% return per year with some level of risk, why would you invest in it when you know you have a risk-free option with a saving account for a 2% return per year as well? I would not invest in such a project, and neither would you. By the way, let's add here a new keyword to our list, risk. Taking on a riskier project should yield a higher return to compensate you for the risk you are taking. At the end, it sounds logical. Safer bets yield less return than riskier ones. The last criterion to making an informed investment decision is related to the pace at which you will be getting the return. Will it be the same amount every year? Will it be increasing over time? Or will you be getting it all at the end? When you get the return from the project is going to have an impact on the overall return of your project. We will see in a later chapter why the faster you get the return and the more attractive the investment would be. To summarize, when comparing projects, the return in itself is insufficient to determine if it's a good or bad investment decision. The elements to be considered are: does the project have a positive return on investment? What are all the investment opportunities available to you, and what return do they yield? What level of risk are you comfortable with? Is the return sufficient to compensate you for the risk you're taking? And at what pace will you be getting the return? Making the difference between an investment opportunity that is suitable to you and one that is not will require a financial methodology that you will learn in the next chapter called the net present value, or NPV, as well as applying personal judgment on the strategy of the project. Both are essential to selecting projects that will meet your return expectations. As we have seen, every investment is expected to deliver a return. I'd like to take some time now to discuss in more detail what we mean by return. The word return is usually understood as a positive return, meaning that it is bigger in value than the capital originally invested. The definition of a return is actually broader than that, and does not always mean it is positive. You can have positive as well as negative returns, or no returns at all. If what you get from your investment is equal to the capital invested, then you're not making any return. If it's higher than the capital, then you're making a positive return. If you're getting a lesser amount than the original capital, you're making a negative return. The return is the difference between what you invested, the capital, and what you're getting back from your investment. Let's take a concrete example to illustrate this. Let's say you're investing $1,000 into a project and get back from it $1,100 in 1 year. The difference between the $1,000 capital and the resulting $1,100 is $100. This is the return you have made. Usually, returns are displayed in percentages per year. So in our example, because we have generated $100 in 1 year for a starting capital of $1,000, we can say that a 10% return per year has been generated. The formula to calculate the return in percentage for a 1-year investment is the following: return divided by capital. You can also calculate it by taking the N value divided by capital minus 1. Those two formulas provide the exact same result. For a multi-year investment, the formula is a bit different. You first have to calculate the N value divided by the capital, and then you have to take it to the power of 1 divided by the number of years. You take all of that and do minus 1. To illustrate the multi-year formula, let's assume that investment happened over the course of 2 years instead of 1. Then we would have calculated the return percentage in the following way. First, divide 1,100 by 1,000. Take this result and put it to the power of 1 divided by 2, which is the number of years. Take this result, minus 1 is equal to 4.9%. So this investment is producing over the course of 1 year a 10% return. But if it is producing its return over the course of 2 years, then it's an average of 4.9% return per year. If we take back now the 1-year example, but assume we are getting back $900 in the end, our return becomes then a loss of $100. In percentage terms, this becomes a minus 10% return. It is a negative return. $900 divided by $1,000 minus 1 is equal to minus 10%. Now let's put one thing out of the way right now. A positive return is not sufficient by itself to qualify as a good investment. This is a shortcut that is commonly made, but other factors need to be taken into consideration, such as other options available to you, for example. In this chapter, we will learn about a financial methodology called the net present value, or NPV, which is widely used by finance professionals to assess investment opportunities. The NPV is actually a mathematical formula which combines the capital invested, the pace at which the return is generated, the expected return, and the risk level to produce a single number result that determines if an investment is worthwhile. That formula computes all of the inflows of money and outflows of money of the project. Those are called cash flows. So for example, the capital that you invest is a negative cash flow since you're spending money. And any financial return will be a positive cash flow since you are receiving money. If the result of that calculation is equal to 0 or greater, it's a good investment. If it's negative, then it's not. How great does that sound? A mathematical formula that tells you how good an investment is? Well, there's a trick to it, and a big one. The formula in itself is not the most important aspect of the NPV methodology. It is how you determine the factors you put into it that will make your NPV reliable. For example, you will need to assess the risk associated with the project. There's no precise science to determine risks, but there are ways to do it, which we will see in a later video. The same goes for the expected level of return. No science, but ways to do it. In this chapter, we will look into how to best assess each of the NPV factors so that when we get into calculation time, we have the most robust information gathered so that our NPV calculation and ultimately our investment decision is based on the best information available at the time of the decision.
And then, there was this guy who's like, what, late 90s, Jeff, right?
Yeah, something like that. Yeah.
And, your eating habits at this point in your life were not great.
No. This is, you won't even believe this story. You're just going to have to believe me that I tell you this is true. I had been eating for breakfast every morning a whole can of Pillsbury biscuits. So I would wake up in the morning, I would preheat the oven to 375, I would get out the baking sheet, I would crack open the Pillsbury biscuits, place them on there, and with butter. And I would eat the whole can. And I was skinny as a rail. And it was just, after watching me, so then we get married, and she watched me do this every morning as my spouse for like 3 months. And then she finally stopped me one day, and she said, "Do you know what's in that?" And I was like, honestly, that wasn't even a concept for me, that there was something in food. That there was like I had never read a nutrition label in my life. I ate what tasted good to me. And so she kind of showed me the ingredients label, and we had a little very rudimentary discussion about nutrition, and I stopped eating the biscuits.
Well, I'm frankly very happy and somewhat surprised you survived all of that. We're glad you're still with us. So
she was incredulous. She couldn't believe it.
So one of the things I want to talk about, a question that we've talked about before. You were 30 years old in 1994 when you decided to start Amazon.com. Mm-hmm. You had a great job. I remember you had a great apartment on the Upper West Side.
I've been married for a year.
You've been married for a year.
I had not been eating biscuits for 9 months.
And I'm just, how did you go through making the decision to drop what was a very good job and take this chance? It all seems very obvious now, right? This many years later that it paid off, but at the time it was not obvious.
No, it wasn't. And I did do a lot of soul searching. I went to my boss at the time, and I really liked my job. And I told my boss I was going to go do this thing, start an internet bookstore. And my wife I'd already told my wife, and she's like, "Great, let's go." And I said to my boss, he's like, "This is a good idea." He said, "I think this is a good idea, but it would be an even better idea for somebody who didn't already have a good job." And that sort of made some logical sense to me, and he convinced me to think about it for a couple of days. So I went away. I was really trying to get my head around how to think about this. And I think, for me, the right way to make that kind of very personal decision, because those decisions are personal. They're not like data-driven business decisions. They are, what does your heart say? And for me, the best way to think about it was to project myself forward to age 80 and say, look, when I'm 80 years old, I want to have minimized the number of regrets that I have. I don't want to be 80 years old in a quiet moment of reflection, thinking back over my life and cataloging a bunch of major regrets. And I think that regrets, our biggest regrets, in most cases, you can murder somebody, okay, you'd regret that. But in most cases, our biggest regrets turn out to be acts of omission. It's paths not taken, and they haunt us. We wonder, what would have happened? I loved that person, and I never told him. And then they married somebody else. I didn't do this. And so that's the frame of mind that I put myself in. And once I did that, once I thought about it that way, it was immediately obvious to me. I knew that when I'm 80, I would never regret trying this thing that I was super excited about and it failing. If it failed, fine. I would be very proud of the fact when I'm 80 that I tried. And I also knew that it would always haunt me if I didn't try. And so that would be a regret. It would be a 100% chance of a regret if I didn't try, and basically a 0% chance of regret if I tried and failed. So I think that's a useful metric for any important life decision.
And this is, our sister took this photo. But she was, I don't quite know why she thought this was a momentous occasion. This is you at McKinsey.
Yeah, we're about to take off driving across the country to start Amazon, go to Seattle.
And that's
my yellow lab, Kamala, named after a Star Trek character.
We're so happy to have these family photos, but we can't for the life of us figure out why Christina bothered to take them, but we're so glad she did. And then, she also was smart enough to tell you to leave the dog.
Yeah, she saved us probably because we were going to drive across country with the dog, which was probably not a good idea. Yeah. So she said, why don't I keep the dog, and after you guys get settled, I'll send you the dog.
So a question I have is, we just talked about the fact that, there was certainly no guarantee that Amazon was going to work.
No, there never is any kind of startup.
I think, what would Jeff Bezos be doing if this hadn't worked out?
I think it's a good question. Nobody ever really knows what twists and turns life takes. My best guess is I would be a very happy software engineer.
Yeah. And working on anything in particular?
Well, today I might be, I don't know, I'm very, very curious about machine learning and artificial intelligence, and at Amazon we're doing a lot of that. Probably I would be attracted to that field today.
And if, I thought of this question, I'm not sure exactly how you would answer it, but I am curious to know, like your fantasy job, not the one that would pay the bills.
Well, that I have, and you know what it is.
I think
he knows.
My guess is bartender.
Yeah, I do have, by the way, I'm really glad I'm wearing my Honey Badger Don't Care t-shirt there. Thank you for that photo because it looks like I've had about 4 of those already. I appreciate that.
That looks like a Bloody Mary. That's an early start.
What are brothers for?
That's an early start.
But yeah, I have this.
You make a mean cocktail.
I do. I pride myself on my craft cocktails, and I do have this fantasy that I want to be a bartender. And I know that it is a fantasy. Like if I were actually a bartender, they're probably like I've glamorized the job in my mind. I know that. But I love people. I like talking to people. I love making cocktails.
You're not very fast.
I'm super slow. It would have to be a craft cocktail bar. We'd have to charge a lot per drink, and there'd be a big sign behind the bar that says you can have it good or you can have it fast, which you want, that kind of thing. But yeah, I have a kind of fantasy there.
So if we could shift gears a little bit, I want to talk about Blue Origin.
Yeah.
So Blue Origin is your private spaceflight, commercial spaceflight company, and we'll talk in a minute about all the work that you're doing in that regard. But I guess what I want to focus on for a minute or two is the inspiration for that, the passion behind it. So, I'm going to put up a photo now, and this one's really more embarrassing for me than for you. But so here we are.
You look like you're about to block a soccer kick or something.
I'm auditioning for Alan.
And that's on the far right there is our dad,
That's Chico and the man over there on the right.
He's Cuban, and it's a kind of, it's one of those tricks that the universe plays on you that my mom's name is Jackie and my name is Jeff, and there's no J in Spanish. And so he still has to call her Yaki and me Yef. And, but he sounds exactly like Ricky Ricardo, and he's a delightful guy. But yeah, that's the whole crew there.
That's the whole crew there. So you were the valedictorian of your high school in Miami, and had the opportunity to give a speech at your graduation. And I think the vast majority of your speech was about colonizing space.
I think all of it.
I think all of it as well. Yeah. Right. So and I still remember your closing line. I mean, even then, it stood out to me. Yeah. And it was, do you remember it?
I do. I remember the close. It was something like, space, the final frontier, meet me there.
That was it.
That was, yeah. So, and I've been passionate about space, rockets, and rocket engines since I was a 5-year-old boy.
And so, I want to talk about that a little bit because, we've talked about, or, certainly the story you've told about having seen the moon landing in 1969, right? So this is Pop again.
That's Christina, right?
That's our sister on the floor. So this was a very familiar setting for us. Anytime Pop was watching TV, he was laying on he had perfectly good furniture. I could see it, but
yeah, no, he liked to lay on the floor.
Laid on the floor to watch television. Yeah. And you remember seeing exactly like this when you were watching the lunar landing.
Yeah. No, that was his posture. Yeah, and I do think you never know exactly. You don't choose your passions choose you. How they're formed, you're never completely sure. But I do think you get imprinted somehow early on with certain things. You just get excited about them, and because you're excited, you pay more attention, and they grow. And that's space is like that for me. I watched Neil Armstrong step onto the moon when I was 5.
And I do wonder. I know that Pop was a big fan of the Watergate trials. Also watched those in the
I
same setting.
Just like this. He was kind of a news junkie anyway. But he obsessively watched the Watergate hearings.
Do you?
Yes. Was it something wrong?
There's always something wrong.
You have to
at any given point, there's always something wrong.
Yes.
Because there's just too many things going on.
Yeah.
So one of the trickiest things about a car is that there's thousands of individual components, there's thousands of unique components, and even if one of those things is missing, you can't make cars.
Yes.
So today's fiasco was, I kid you not, we were missing $3 USB cable. Okay, so we could not complete cars because
so the whole line was stopped.
Yeah. So essentially because it's part of the wiring harness, so you can't put the interior in without this cable. And so we could either make a whole bunch of cars minus an interior, which means that you got to stack them up in the yard.
The resale value would be no good.
Well, it can be done, but it's then things go out of sequence.
Oh, right.
And it's way more it's way more inefficient. You don't have a moving production line. You have to send people out to hundreds of cars that are sort of sitting in the storage yard, and so this happens to be a particularly pernicious cable that's kind of like routed under the carpet and in a difficult place, and it's literally $3. So we basically had to send people throughout the area to go and buy USB cables.
Like little Radio Shack.
Like Fry's.
Oh, Fry's. Oh, that's better.
You can have a hard time getting a USB cable right now at Fry's.
Oh, really?
Every one of them.
That's good.
And so we were able to continue production. And I don't belabor the anecdote, but essentially the supplier is in China. And we had Plan A and Plan B. And Plan A was like the normal supply chain process. And but what the supplier did was instead of sending our parts in their own package, they grouped it together with a bunch of other stuff for other companies and sent that all via some extremely slow boat from China to LA. And when it got to LA, the other stuff didn't pass customs.
Oh.
And so they wouldn't let our stuff through because
they put it in like a barrel of fruit or something.
I don't know what they put it in.
Yes.
There's something that customs didn't like, and the paperwork wasn't in order or whatever. So it got stuck there for like a couple of weeks. Yeah. And then we had Plan B. So we called and said, look, you've got to air freight some of these cables, digital cables, to us. And we talked to their U.S. subsidiary and ordered from the U.S. subsidiary, who then communicated to China. But then, because this was another batch of parts, it was kind of double the order, it exceeded the credit limit that we had.
Oh, yeah, you got it.
So it bounced off the credit limit, so they didn't ship it.
Fascinating. So someone's losing their job now. This is not. No, you should fire anyone.
It's pretty farcical.
Oh,
and anyway, so it's coming like tonight at 11 p.m. or something.
Wow. And these things are happening like all the time. This was like an unusual circumstance.
Yeah. That's like one example, but there's many things like that.
So I guess that's actually a really good example because that kind of leads into what I've always been fascinated by a lot of what you're doing is, I'll start with, how did you get into this? I mean,
into cars?
Into taking over NASA, not taking over NASA, being a contractor for NASA.
For the record, we're not taking over NASA.
You're not taking over NASA, they're an independent organization. But you all are becoming a major provider of services for NASA, obviously kind of internet payments and payments generally. I mean, these are three completely different spaces. I think a lot of people would not take someone seriously if they kind of had a business plan in one of these.
Right. Sorry,
you take your time. What was your, did you always think you were going to be doing this? Or when did it dawn on you that you would try to revolutionize 3 industries?
Well, when I was in college, I didn't actually expect to do it. So it was not like this is some long-fulfilled expectation. But when I was in college, I thought about what were the areas that would most affect the future of humanity, in my opinion. And the 3 areas were the internet, sustainable energy, and space exploration, particularly if humanity becomes a multi-planet species. There's kind of like a pretty substantial bifurcation in our sort of future if we're either out there among stars on multiple planets, or if we're confined to Earth until some obviously eventual extinction event. Not that I'm pessimistic about life on Earth. I mean, I think things are likely to be good.
But even,
more likely to be good by far.
Yellowstone's due for an explosion every 100.
Right,
exactly.
exactly.
About that. It's been 700,000 since.
Right.
But yes.
Yeah.
Super volcano, for those of you who don't know, it would envelop. Well.
Yeah. No. Exactly. I know exactly what you're talking about. Exactly. So
we read the same books. I can tell.
Absolutely.
Yes.
I mean, something bad is bound to happen if you give it enough time. And civilization has been around for such a very short period of time that these time scales seem like very long, but on an evolutionary time scale, they're very short. A million years on evolutionary time scale is really not much. And it's been around for 4.5 billion years. So that's a very tiny amount of time, really. But for us, that would be. I mean, can you imagine if human civilization continued at anything remotely like the current pace of technology advancement for a million years? Where would we be? I mean, I think we're either extinct or on a lot of planets.
Yes, we should.
those are the two options.
But given that, I mean, one, that's kind of as epic as one can think about things. I mean, literally. I mean, how did you make that concrete? How does that turn into SpaceX, Tesla, and PayPal?
Well, so I thought about these things kind of in the abstract, not from the expectation that I would actually have careers in those arenas, but I wanted to be involved in at least one of them. And at first I thought the best bet was going to be electric cars. And so the area that I was studying was advanced capacitors. So essentially capacitors that have an energy density exceeding that of batteries. Because they have a very high power density, but low energy density. Maybe a lecture to that.
Oh, yes, no, we should do that. We'll get to later.
Exactly. Obviously, if you could make a capacitor that had anywhere near the energy density of a battery, and with incredibly high power density and it's quasi-infinite cycling calendar life, then you would have an awesome solution for energy storage in mobile applications. So that I was going to sort of work on that and try to leverage the equipment that was developed for advanced chip making and photonics to create ultra-precise capacitors at the molecular
And this is when you were going to go into grad school?
Yeah,
you had a brief stint at Stanford.
That's right.
For a PhD in applied physics?
Applied physics and material science.
Right. This is what you were. So even then you were thinking of kind of trying to do something in space.
Well, actually, this was to work on energy storage solutions for electric cars. And I'd actually worked at a company in Silicon Valley called Pinnacle Research, which did advanced capacitors. They were electrolytic capacitors, sort of, and the problem, and actually were pretty good. They had like the energy density of a lead acid battery, which for a capacitor that's a big deal. But they used ruthenium tantalum oxide, and I think at the time there was maybe like 1 or 2 tons of ruthenium mined per year in the world. So it's not a scalable solution. But I thought there could be some solid state solution, say, using chip making equipment. That was going to be the basic idea. But it was one of those things where I wasn't sure if success was one of the possible outcomes. And like it's difficult to bound that problem exactly and say, okay.
So you're saying I felt like this was a destined failure. Is another way to parse that sentence. But anyway, sorry.
No, I didn't think it would fail, but I wasn't sure that success was a possibility.
Okay. Yes.
And generally, you want to embark on something. It's desirable to figure out if success is at least one of the possibilities.
Right. Exactly.
Because for sure, failure is one of the possibilities.
Yes.
But ideally, you want to try to bracket it and say success is in the envelope of outcomes. And I wasn't quite sure if that was the case. I think success on an academic level would have been quite likely because you can publish some useless paper, and most papers are pretty useless.
We have a few. Don't take offense.
I mean, how many PhD papers are actually used by someone ever? That's
a good point.
Percentage-wise, it's not good. So it could have been one of those outcomes where you add some leaves to the tree of knowledge. And that leaf is, nope, it's not possible. There goes 7 years mile. So that was one path, and I was prepared to do that. But then the internet came along, and I was like, okay, the internet. I'm pretty sure success is one of the possible outcomes, and it seemed like I could either do a PhD and watch the internet happen, or I could participate and help build it in some fashion. I just couldn't stand the idea of watching it happen. So I decided to put things on hold and start an internet company, and that was kind of we worked on internet publishing software, maps and directions, yellow pages, kind of things, and we had as investors and customers, the media companies, so like New York Times Company, Knight Ridder, Hearst.
This was just at the early stages. I mean, this was like late 95. So it's really early stages. So it's really out the gate.
Yeah, absolutely. And so then the reason we worked with media companies is because we had money. Like there was no advertising money in 95.
Right.
In fact, the idea of advertising the internet seemed like a ridiculous thing to people. Obviously, it's not ridiculous anymore. But at the time, it seemed like a very unlikely proposition. And a lot of media companies weren't even sure that they should be online. Like, what's the point of that?
And did y'all think that PayPal was just going to be a simple little internet way to, or do you think it was going to turn into the major kind of transaction processing engine that it is right now?
I didn't expect PayPal's growth rate to be what it was. So, and that actually created major problems. So we started PayPal on University Avenue. After the first month or so of the website being active, we had 100,000 customers.
Really? Wow, I didn't realize it was.
Yeah, it was nutty.
Wow. And how did it start? How did people just even know to use it? And I mean, obviously, both buyer and seller have to be involved.
Yeah. Well, we started off first by offering people $20 if they opened an account, and $20 if they referred anyone.
Oh.
And then we dropped it to $10, and then we dropped it to $5. As the network got bigger and bigger, the value of the network itself exceeded any sort of carrot that we could offer.
How much money did you spend with that kind of $5, $10, $20 incentive to get that critical mass going?
That was a fair amount. I think it was probably $60 or $70 million.
Oh, wow. Okay, so it was a substantial.
Yeah,
oh, okay, so we're not talking peanuts here. Yeah, this is.
Yeah, it depends on your relative scale.
Yeah,
it's a peanut to Google.
Yes, no, that's right. That's right.
Yes, peanut.
Yes, yes.
I mean, like Google's got 50 billion, Apple's got, I don't know, 150 billion, some crazy amount of money.
Wow,
That's
yeah.
cash.
Yeah. So it's not an outland. Well, yeah, no, I didn't realize. That was so
Google's
core.
cash would be $500 million. So that's 0.1% of Google's.
That's true. You're right. That's inexpensive. It's not
relative
expensive.
to them, it's pretty inexpensive.
Yeah, well, that's right.
And then we just did a bunch of things to decrease the friction because it's just like bacteria in a petri dish.
Yeah.
So what you want to do is try to have one customer generate $150 billion, some crazy amount of money.
Wow,
That's
yeah.
cash.
Yeah. So it's not an outland. Well, yeah, no, I didn't realize. That was
1%
so
of Google's
core.
cash would be $500 million. So that's 0.1% of Google's.
That's true. You're right. That's inexpensive. It's not
Relative to
expensive.
them, it's pretty inexpensive.
Yeah, well, that's right.
And then we and it'll just it'll expand very quickly until it hits the sides of the petri dish. And
Yeah.
it slows down.
And then after PayPal, then, I mean, to some degree, especially us in Silicon Valley, we can understand the internet. We know people. I mean, PayPal's obviously of a scale that, is noteworthy. But then SpaceX just seems really, like, how did you decide that I'm definitely going to do that? And then, like, what's the first thing that you do? Like, how do you even, like, go out? Like, I don't even know how to start trying to make a rocket company.
Well, neither did I really. And in fact, the first 3 launches failed. So it's not as though it was like, spot on. It's like, did not hit the bullseye.
But even getting to the point that you're launching rockets, I don't even know how to, like, how do you get there? And like, what did you do on, like, one, how did you decide? And then what did you do on day one? Like, who did you call? Or did you know?
Yeah, actually, I mean, the origin of PayPal or rather SpaceX is that I was trying to figure out why that we'd not sent any people to Mars. Because the obvious next step after Apollo was to send people to Mars. So but what in fact happened was that we sent a few people to the moon, and then we didn't send anyone after that to the moon or Mars or anything. But if you'd asked people in 1969, what would 2013 look like? They would have said there'll be a base on the moon. We would have at least sent some people to Mars, and maybe there'd even be a base on Mars. There'd be like orbiting space hotels, and there'd be all this awesome stuff in space. And if you'd said, well, actually, the United States in 2013 will not be able to send anyone to orbit. But I'll tell you what will exist is that there'll be this device in your pocket that's like the size of it, smaller than a deck of cards, that has access to all the world's information, and you can talk to anyone on planet Earth. And even if you're like in some remote village somewhere, as long as there's something called the internet, they wouldn't know what that means, of course, then you'd be able to communicate to anyone instantly and have access to all of humanity's knowledge. It's a bit like bullshit. There's no way that that's going to be
Right.
And yet we'll have that, and space is not happening. So I was trying to figure out like what was the deal here. And this was 2001. There was just a friend of mine asked me, what am I going to do after PayPal? And I said, well, I've always been interested in space, but I don't think there's anything that an individual could do in space because it's the province of government, usually large government. But I'm curious as to when we're going to send someone to Mars. So I went to the NASA website, tried to figure out like, where's the place that tells you that. And I couldn't find that. So I thought, well, like, either I'm like bad looking at the website or they have a terrible website, because surely there must be a date.
That should be a big date,
Yeah, it should be like, this is the real front page. And then I discovered actually that NASA had no plans to send people to Mars, or even really back to the moon. So this was really disappointing. I thought, well, maybe this is a question of national will. Like, do we need to get people excited about space again, and try to get NASA a bigger budget, and then we would send people to Mars. And so I started researching the area, becoming more familiar with space, reading lots of books, and came up with this idea to do something called Mars Oasis, which was to send a small greenhouse with seeds and dehydrated gel. That would land. Upon landing, you hydrate the gel. You have green plants on a red background, and the public responds to precedents and superlatives. So it's the first life on Mars, the furthest that life's ever traveled, and you'd have this money shot of green plants on a red background. So that seemed like it would get people pretty excited. So I started getting into this and trying to figure out, okay, well, can I afford to build the spacecraft? Because I had some money from as a result of PayPal, but it had to fit within that budget. And I figured we had to do 2 missions because if we only did one and it failed, then it might have like the opposite effect.
But you were willing to bet the farm, so to speak, on this.
Well, I figured like I was willing to spend half the money that I got from PayPal with no expectation of return. Because I thought this was just something that was pretty important, and I'm like, it seemed like I could spend half the money on PayPal on this, and if that got NASA a bigger budget and resulted in us going to Mars, that would be a pretty good outcome.
And when your friends came or your family came up to you and said, look, there's nations that can't do this. You're a guy, but you have some resources. What did you say or do or think?
Well, so I had a lot of friends of mine try to talk me out of starting a rocket company because they thought it was crazy, and one friend of mine made me watch a video of rockets blowing up. And there were just lots of people that thought it was a really crazy idea, and there were some people that had tried to start rocket companies, not succeeded, and they tried to talk me out of it. And but the thing is that the premise for talking me out of it was, well, we think you're going to lose the money that you invest. I was like, well, that was my expectation anyway, so I don't really mind if I lose. I might, but I mean, it's not like I was trying to figure out the rank ordered best way to invest money, and on that basis, chose space. It's not like that's.
Market bonds, AAA bonds, rocket company. You weren't like
do real estate, invest in shoemaking, and space is highest ROI. That's not what I. That wasn't the premise. I just thought that it was important that humanity expand beyond Earth, and we weren't doing that. So maybe there was something I could do to kind of spur that on. And then I was able to compress the costs of the spacecraft and everything down to a relatively manageable number. And I got stuck on the rocket. The US rockets were way too expensive. I ended up going to Russia, flew to Russia 3 times to negotiate purchase of an ICBM. I tried to buy 2 of the biggest ICBMs in the Russian fleet in 2001 and 2002. And actually negotiated.
I'll just let that statement stand. I'm not even.
I mean, that's.
Actually, I have to. Like, who did you call?
The yellow pages.
Yeah, 11 on the market. I mean, how does this? I don't want to get too much in the way, but I am curious. Just this one particular thing. You decided at some point you need to buy an ICBM.
Yeah. Well, actually, at first I tried to buy just a normal launch vehicle that they used to launch satellites. Those were too expensive.
I see.
The Boeing Delta II would have cost $65 million each, and so 2 would have been 130, and then I was like, well, okay, that breaks my budget right there. And I tried to negotiate with them, and that was not.
How much does an ICBM go for? I'm curious. What's the market rate for one of those?
Well,
this was right after the fall. It might have gone up.
Yeah, it's gone up a lot since then. But in 2001, it would have been about $10 million each so 2 would have been 20, and then I thought I could get the rest of the mission down to also around 10 per. So we'd have a dual mission with like 2 identical launches, 2 identical spacecraft, and for like roughly $40 million. And so I thought that, okay, I can do that.
But you must have had some rocket scientists advising you at this point. I mean, this sounds like you were serious. I mean, you were.
Yeah, engaged a bunch of consultants. And kind of started to get familiar with the space industry. And But then after the third trip to Russia, I came to realize that I was actually wrong about that on my first premise, that there was a lack of will. In fact, I think that there's a tremendous amount of will in the United States for space exploration. Because the United States is essentially a nation of explorers. I mean, it's a distillation of the human spirit of exploration. So of course, it was quite silly of me to think that people lack motivation. But what people don't want to think is that, okay, sending people to Mars is going to be so expensive that they'll have to give up like healthcare or something.
Right.
Yeah, they're not going to do that. So it's got to be, it's got to be that going to Mars is not going to cause some meaningful drop in their standard of living.
Right.
Yeah, right. So if it's like maybe 0.25% or 0.5% of GDP, something like that is palatable. Right. Anyway, so I thought, okay, it's not really going to maybe matter that much if I do this mission, because what really matters is having a way. So I was wrong. I thought there wasn't enough will, but there actually was plenty of will if people thought there was a way. So then I said, okay, well, I need to work on the way. Yeah. How hard is it really to make a rocket? Historically, all rockets have been expensive, so therefore, in the future, all rockets will be expensive. But actually, that's not true. If you say, what is a rocket made of? And say, okay, it's made of aluminum, titanium, some copper, carbon fiber, if you want to go that direction. And you can break down and say, what's the raw material cost of all these components? And if you had them stacked on the floor and could wave a magic wand so that the cost of rearranging the atoms was zero, then what would the cost of the rocket be? Yeah. And I was like, wow, okay, it's really small. It's like 2% of what a rocket costs. Right. So clearly, be in how the atoms are arranged. Right. The other, so you got to figure out sort of, okay, how can we get the atoms in the right shape much more efficiently? Yeah. And so I had a series of meetings on Saturdays with people that were some who were still working at the big aerospace companies, just to try to figure out, is there some catch here that I'm not appreciating? And I couldn't figure out, there doesn't seem to be any catch, so started SpaceX. And you ended up, I mean, you had some failures, but obviously some huge successes. What was the cost that you were able to build this rocket for relative to what they were being built for before? So let's see. For the Falcon 1, which is the first rocket we built, and the first 3 flights did not make it. In fact, I mean, we got sort of progressively further, but like the first rocket came and landed maybe a couple hundred yards away from the launch site, and tiny fragments. Anyway, that rocket ended up costing around $6 million. Wow. Compared to other rockets in that class, which were about, say, $25 million. Wow, so significant. Yeah, like a quarter. Wow, wow. But there's an even better step beyond that, which is to make rockets reusable. Yeah. So right now, that is around what our comparison price is, excluding the refurbished ICBMs. Yeah. So if you say, building a rocket from new, how does the SpaceX rocket compare to a rocket from Boeing or Lockheed? It's about a quarter of the price. However, if we make it reusable, then it can be 2 orders of magnitude cheaper. 2 orders of magnitude cheaper. Well, 1/100th the price. That's right. So I mean, and I've seen you for volleyball. Only today, Memorial Day sale. And I've seen some. Y'all are doing like these vertical landings. Yeah. Like literally out of like the 1950s like sci-fi movies. Yep. And that's what you're talking about. Yeah. Yeah. Essentially, the rocket needs to come back and land at the launch site, and then reload propellant, take off again. Like an airplane. And how far do you think we are from that? Like when do you think, your best guess, when we'll actually see that happening? I'm hoping we can do it next year. Oh, okay. Yeah. Let's. We got some ambitious stuff at Khan Academy for next year, too, so we can compare. We're redesigning the site, Right. We've been working on it for a long time. I should say, SpaceX has been around for 11 years, and thus far we have not recovered any rockets. We've recovered the spacecraft from orbit, so that was great. But none of our attempts to recover the rocket stages have been successful. The rocket stages have always blown up basically on reentry. Now we think we figured out why that was the case, and it's a tricky thing because Earth's gravity is really quite strong, and with an advanced rocket, you can do maybe 2 to 3% of your lift-off mass to orbit, typically, and then reusability subtracts 2 to 3%. So then you've got like nothing to orbit or negative. Right. And that's obviously not helpful. So the trick is to try to shift that from say 2 to 3% in an expendable configuration to make the rocket mass efficiency, engine efficiency, and so forth so much better that it moves to around maybe 3.5 to 4% in an expendable configuration, and then try to get clever about the reusability elements and try to drop that to around the 1.5 to 2% level. So you have a net payload to orbit of about 2%. But you're doing it at 2 orders of magnitude cheaper. Yeah, absolutely. Because our Falcon 9 rocket costs about $60 million, but the propellant cost, which is mostly oxygen, that's 2/3 oxygen, 1/3 fuel, is only about $200,000. Wow. And it's much like a 747. It costs about as much to refuel our rocket as it is to refuel 747. Within you're pretty close essentially. So what happens? Assuming y'all are successful and y'all have proven yourself to be successful on kind of these audacious things in the past. I mean, what happens? I mean, that seems like it's. And what happens in the next 5-10 years in the space industry if y'all are successful there? I mean, do we get to Mars? Do we have kind of market forces, commercialization of space starting to happen? Yeah. Let's see. Well, the first step is that we need to earn enough money to keep going as a company. So we have to make sure that we're launching satellites, commercial satellites like broadcast communications, mapping, and the government satellites that do scientific missions, Earth-based or space-based missions, GPS satellites, that kind of thing, and then also servicing the space station, transferring cargo to and from the space station, which we've done a few times, and then taking people to and from the space station. So we've got to service the sort of needs, Earth-based needs to launch satellites, and that pays the bills. Yeah. But in doing that, keep improving the technology to the point where we can make full reusability work, and we have sufficient scale and sophistication to be able to take people to Mars.
Wow. And so you think this is going to be a reality? What's your best guess of when we're going to have someone on Mars?
I think probably about 12 years.
12? That's not. And you think it'll be a round trip? It won't just be some type of permanent colony on Mars? Yeah.
I think it's probably a round trip.
Wow. so for
I mean, it's not for sure.
I could talk about this for. I mean, the people know.
So the aspiration will be a round trip.
Yeah. No. This is mind blowing. And I mean, then on Tesla. I mean, Tesla is obviously, I mean, from my vantage, it's a huge success. I mean, what do you think is in that industry? Well, one, I mean, I'll ask kind of the same question. What did you think? This is something that GM and Toyota and these massive multi-billion-dollar organizations have been trying. What gave you the confidence to kind of pursue it? And now that it seems to be a huge success, where do you think this industry is going to be in the next 5-10 years?
So with Tesla, the goal is to try to accelerate the advent of sustainable transport. I think it would happen anyway, just out of necessity. Yeah. But because we have an unpriced externality in the cost of gasoline, we were pricing in the environmental effects of CO2 in the ocean's atmosphere. That's causing the normal market forces to not function properly. And so the goal of Tesla is to try to act as a catalyst to accelerate those sort of normal forces, the normal sort of market reaction that would occur. We're trying to have a catalytic effect on that. Yeah. And try to make it happen, I don't know, maybe 10 years sooner than it would otherwise occur. Yeah. That's the goal of Tesla. So that's the reason we're making electric cars and not any other kind of car. And we also supply powertrains to Toyota and to Mercedes and maybe to other car companies in the future to accelerate their production of electric vehicles. So that's the sort of goal there. And so far, it's working out pretty well.
I mean, I just saw a news report earlier today that y'all are sold more Model S's than y'all are leading that segment of the industry, the Mercedes S-Class, the BMW 7 Series, or the Lexus LS 400, whatever it is.
Yeah, actually, that seems to be the case. And it's, I didn't realize they sold so few cars in that segment. We don't sell that many cars. We sell 5,000 a quarter.
Well, out here they seem like, every
I mean, this is our home.
Yeah.
It's our home team, So it's, we better sell out the Bay Area.
Yeah. No, but that's, well, I mean, similar thing. I mean, how did you start? What gave you the confidence? And I mean, do you see yourselves? I mean, it's kind of a major automotive mainstream brand in 5-10 years, all the way down to kind of the competing with the Honda Accords and Civics. I mean, our goal is not it's not sort of to become a big brand or to compete with Honda Civics, but rather to advance the cause of electric vehicles. So we're just going to keep making more and more electric cars and driving the price point down until the industry is very firmly electric. Like maybe half of all cars made are electric or something like that, which is not to say that we expect to make half of all cars. We want to just have that catalytic effect until at least that occurs. And I think at the point at which there's, we're approaching half of all new cars made are electric, then I think I would consider that to be kind of the victory condition. Wow. So the faster we can bring that day, the better. Wow. When would be your guess when that happens?
Well, I made a bet with someone about 3 years ago that it would be sooner than 20 years. So it's 17 years from now. But that's, I think, that's conservative. I think it's probably, maybe 13 or 14 years.
Wow.
Like that.
Right about the time.
Happen,
right when we're going to Mars.
Right.
It'll be exciting times.
Yeah. True. It just could. Yeah. Exactly. I was thinking about that. It was like, this time frames are kind of coincident.
Yeah.
The nature of new technology adoption is it tends to follow an S-curve. So what usually happens is people underpredict it in the beginning because people tend to extrapolate on a straight line, and then they'll overpredict it kind of at the midpoint, and because there's late adopters, and then that'll actually take longer than people think at the midpoint, but much shorter than people think at the beginning. But I'm pretty excited about how things are going. It's and in fact, I think that the pace of technology improvement is in energy storage, electric energy storage is really moving faster than anyone thinks.
Wow. And I got one more. What are we doing on time? Where's Esther? 9 o'clock. So how much time do you have?
Well, I guess maybe another 15 minutes.
Okay. So I'll finish with one last question, then we'll open it up. I mean, what advice do you have for us at Khan Academy?
I guess you're doing really great. So yeah, I was wondering if you had advice for me.
Cool.
I mean, it seems like you're doing an amazing job of really super leveraged. I mean, obviously a small team, and you're having a dramatic effect on.
Yeah, half these people don't even work here. They're just like Stephen. Yeah.
Right. It's right. So it's I think very impressive thing you're doing to spread knowledge and understanding throughout the world.
The universe soon.
The universe,
if you blow up your end of the bargain.
I mean, it's actually kind of funny. If you think like what is education? Like you're basically downloading data and algorithms into your brain, and it's actually amazingly bad in conventional education because it shouldn't be like this huge chore. So you're making it way better. But I mean, I think a lot of things that I would say you've probably heard 100 times. and in fact, or if not doing, like the more you can gamify the process of learning, the better. Like for my kids, I do not have to encourage them to play video games.
Yeah,
okay?
yeah.
I have to like pry them from their hands, like crack.
Yes, yes.
It's like drop that crack needle.
Yeah, yeah. You have that problem at your house too.
Yeah,
Yeah,
exactly.
The crack is addictive. Yeah.
So it's it's to the degree that you can make somehow learning like a game, then it's better. And I think unfortunately, like a lot of education is very vaudevillian. You've got someone standing up there kind of lecturing at people, and they've done the same lecture 20 years in a row, and they're not very excited about it. And that like enthusiasm is conveyed to the students. They're not very excited about it. They don't know why they're there. Like why are we learning this stuff? We don't even know why. In fact, I think a lot of things people learn probably there's no point in learning them because they never use them in the future.
Because who's going to launch a rocket into space? I mean, that's just like, yeah exactly. That never happens.
Well, you have to say, like, people, I think, don't stand back and say, well, why are we teaching people these things? And we should tell them probably why we're teaching these things. Because a lot of kids just in school kind of puzzled as to why they're there. And I think if you can explain the why of things, then that makes a huge difference to people's motivation. Then they understand purpose. So I think that's pretty important. And just make it entertaining. But I think just in general, like conventional education should be massively overhauled. I'm sure you very much agree with that. But I mean, the analogy I sometimes use is like, have you seen like Batman, like the Chris Nolan movie, like the recent one, and it's pretty freaking awesome, right? And you've got incredible special effects, great script, multiple takes, amazing actors, and good sound, and it's very engaging. But if you would instead say, okay, even if you had the same script, so at least it's the same script, and you said, okay, now that script, instead of having movies, we're going to have that script performed by the local town troupe. Right. Okay, and so in every small town in America, if movies didn't exist, they would have to then recreate The Dark Knight. Right. With like home sewn costumes and like jumping across the stage and not getting their lines quite right, and not really looking like the people in the movie, and no special effects. I mean, that would suck. It would be terrible.
That's right. Very.
That's education.
That's education. So with that, and I apologize to all of you guys for hogging up all the time, because obviously I could talk for hours about this stuff. But we do have time, I think 5 or 10 minutes for a handful of questions. If none of y'all have any, I have about 9 more. But yes.
So I noticed I picked up 2 kind of themes from what you were discussing. One was somewhat audacious goals, and the other was I don't think I heard you use the word profit in anything that you spoke about. You seem to be each thing is pointed at like reinvigorating industry or bringing back space missions. How much of your success do you attribute to having really audacious goals, or versus just not being focused on the short term, money coming in, or I don't know, investors?
Unfortunately, one does have to be focused on the short term money coming in when creating a company, because otherwise the company will die. So I think that a lot of times people think like creating a company is going to be fun. I would say it's really not that fun. I mean, there are periods of fun, and there are periods of where it's just awful. And particularly if you're the CEO of the company, you actually have a distillation of all the worst problems in the company. There's no point in spending your time on things that are going right. So you only spend your time on things that are going wrong. And there are things that are going wrong that other people can't take care of. So you have like the worst. You have a filter for the crappiest problem in the company, the most pernicious and painful problem. So I wouldn't say it's. I think you have to feel quite compelled to do it, and have a fairly high pain threshold. And there's a friend of mine who says like starting a company is like staring into the abyss and eating glass. And there's some truth to that. The staring into the abyss part is that you're going to be constantly facing the extermination of the company, because most startups fail. It's like 90%, probably 99% of startups fail. So that's the staring into the abyss part. You're constantly saying, okay, if I don't get this right, the company will die. It can be quite stressful. And then the eating glass part is you've got to do the problems. You've got to work on the problems that the company needs you to work on, not the problems you want to work on. And so that's you end up working on problems that you really wish you weren't working on. And so that's the eating glass part. And that goes on for a long time.
So how do you keep your focus on the big picture when you're constantly faced with, we could be out of business in a month?
Well, it's just a very small percentage of mental energy is on the big picture. Like you know where you're generally heading for, and the actual path is going to be some sort of zigzaggy thing in that direction. You try not to deviate too far from the path that you want to be on, but you're going to have to do that to some degree. But I don't want to diminish that. I mean, I think the profit motive is a good one if the rules of an industry are properly set up. So there's something fundamentally wrong with profit. In fact, profit just means that people are paying you more for whatever you're doing than you're spending to create it. That's a good thing. and if that's not the case, then you'll be out of business, and rightfully so. You're not adding enough value. Now, there are cases, of course, where people will do bad things in order to achieve profit, but that's actually quite unusual. I mean, because usually the rules are set up mostly correctly, like not completely, but mostly correctly.
Well, I think we have time for one more question. Joel?
Yeah, I have an important one.
Okay, very good. Yes.
Okay, so a few months ago you teased Hyperloop. and we haven't heard anything since. So first of all, a few of us engineers were talking about it, and I think we have a few ideas if you need help. But if you feel comfortable, maybe you could tell us a little bit more.
I was reading about the California high-speed rail, and it was quite depressing because California taxpayers are going to be on the hook to build the most expensive high-speed rail per mile in the world and the slowest, which is those are not the superlatives you want. And it's like, damn, like we're in California, we make super high-tech stuff. Why are we going to be spending not the estimates are around $100 billion for something that will take 2 hours to go from LA to San Francisco? I'm like, okay, well, I can get on a plane and do that in 45 minutes. It doesn't make much sense. And isn't there some better way to do it than that? If you just say, okay, well, what would you ideally want in a transportation system? You'd say, okay, well, you'd want something that relative to existing modes of transportation is faster, let's say twice as fast, costs half as much per ticket, can't crash, is immune to weather, and is, you can make the whole thing like self-powering with like solar panels or something like that. That would be great. A good outcome.
Yes.
And so what would do that? And what's the fastest way short of inventing teleportation that you could do something like that? And some of the elements of that solution are fairly obvious, and some of them are not so obvious. And then the details, the devil's in the details of actually making something like that work. But I came to the conclusion that there is something like that could work, and would be practical.
Is this around the evacuated tubes, the vacuum tubes, like the old bank?
Like that. It's something like that.
Yeah. But you haven't been more public with what this is?
No, although I did say that once Tesla was profitable that I would talk more about it. But we haven't done our earnings call yet, so I think I should probably do it after the earnings call. And the things like I'm kind of strung out on the things that I'm doing, so adding another. It's like doesn't that's
learning the guitar. You could pick up all sorts of things.
Right. I tried learning violin. Yes. That's, by the way, a hard thing to learn.
Launching rockets, electric cars, revolutionizing transportation.
I can't play the violin at all. Very horrible. If you think about the future, you want a future that's better than the past. And so if we had something like the Hyperloop, I think that would be like cool. Like you'd look forward to the day that was working. And it's something like that. Even if it only was in one place, from LA, San Francisco, or New York to DC, or something like that, then it would be cool enough that it would be like a tourist attraction, it would be like a ride or something. So even if some of the initial assumptions didn't work out, the economics didn't work out quite as one expected, it would be like cool enough. Like I want to journey that place just to ride on that thing. That'd be pretty cool. And so that's I think how if you come up with a new technology, it should feel like that. You should really, if you told it to an objective person, would they look forward to the day that thing became available? And like it'd be pretty exciting to do something like that. Or an aircraft. Like I thought it was really disappointing when the Concorde was taken out of mission and there was no supersonic transport available. And of course, the 787 has had some issues. But the thing is, the 787, even in the best case scenario, is only a slightly better version of the 777. And it's like, okay, not that exciting.
So this is something that you are working on, and one day in the not too far future, or there's some plans or consultants involved or something. You made some phone calls to Russia.
No, every now and then, like it's sort of percolating away, and then I'm not actively thinking about it, but then there'll be some new element of that. I'll think, oh well, this would make it better.
Fascinating. No, well, I think I'm speaking for everyone. This is like the most epic possible conversation one could have over about the course of an hour, and I think all of us would love to chat with you for hours on end, but thank you so much. I mean, I know you have a lot of free time, so it probably wasn't that big of a deal for you to come here, but yeah, it was a huge honor, and I think it's inspired all of us to go out and change the world and the universe.
Cool.
Thank you very much. No, that was